Hey, this is John Wooten. I've been trading professionally for almost 5 years now, and today I'm going to teach you how to trade stock options, a skill that by all means should change your entire investing career. It is pretty much just the biggest leap that you can take with your investing career, and the biggest jump you can have in your portfolio potential. It's amazing. It's really it's just awesome, and so I'm so glad to be able to give that to you through this course. So what this video is essentially an entire course I recorded for clients that bought my book and also just general advising clients. And I put it all together, and I've had it around for a good chunk of time now, and I thought it would be a great idea to just put it out there and release it because I think it could help a lot of people. And I've seen the students that go through this course, God, just really inspirational, seeing them go from investing in stocks to trading options, and the growth that comes from that is huge because options are essentially the next step in taking on leverage, and they are a leveraged financial derivative. And so when you get really good at trading stocks and then you start trading options, it compounds the knowledge you have to such a great degree and opens up so many doors that without stock options would remain closed. And those doors present just massive opportunities. Stock options are the first vehicle that I've personally had multi-1,000% gains in less than a month, and that's really big for me. And they were really a game changer when I started trading in leveraged investment derivatives. I spent the first 3 years of my trading career doing nothing but trading straight equity, and then I started trading options after I got really good at trading stocks, and I made more in the first 2 months of trading options than I made in the past 3 years. But if I didn't know what I was doing, there's a pretty good chance, and I've seen it happen a ton of times, people lose their entire accounts. And I love seeing students that start out with options succeed, but at the same time it's this Achilles heel where I've seen it happen where you have some success initially, but you don't really have a solid foundation. There's not a base built on your investing skills, and then you try to leverage everything with options. You have to understand options carry, just by their nature, high amounts of leverage and therefore high amounts of risk. And so this is not the place to start if you've never bought a stock before. This is not the place to start if you just downloaded your first brokerage or you just signed up for your first brokerage or whatever. This is not the place to start. You really want to understand what moves the stock, and you want to have trading experience with stocks. If you are just starting out, or if you're a complete beginner, I'm going to put a link below for an introductory course I have on how to trade stocks, how to, fundamentals, technical analysis, all the things you really need to know, taking you from essentially never buying a stock, going from zero to really proficient 100, investing really well. Because you need to, coming into this, you need to be able to trade really well, which is awesome because that's what you're going to learn in this course. My point is that you really do need to understand how to invest, because stock options they're leverage, right? And you can blow up an account. I've blown up 3 or 4 accounts easy, not knowing how to, well, that was learning how to trade stock options. I can't imagine how many accounts I blew up if I didn't actually know how to trade the stocks I was trading the options on. So it is going to be really important that you understand stocks going into this. So like I said, course below, if you haven't really had a lot of experience in stocks, I would recommend that before you go through this. And now that assuming that you're ready to learn about it, I am happy to introduce you to this course on stock options. So I'll see you guys in the first lecture, in the first module. Bye.
Awesome. Hey guys, John Wood. You're super excited to be teaching the Options Masterclass today. Freaking awesome stuff. I am so excited about this. I just had a trade recently and there's so many option trades I've been doing lately, and it's so cool. This it's FLWS, and oh my god, just an awesome example of the power of options trading. The stock was up and up, and then it goes down. It goes like $10. I buy the thing at $10. It goes to like $20. I sell the thing at $20. Then it goes to like $25, which is freaking crazy. Now here's the cool part, right? You look at the moving average. You've got like your 200 down here, your 100 here, and your 50 right here. This is like probably $13, and this is about $10. Okay. Now these are daily, weekly moving averages, pretty conservative. This is like all early on, and you guys have got your copy of 9 to Noon, which is awesome. So you guys have the tools, you got the knowledge in your hand, and the purpose of this class really is to elaborate on that in a very, very special opportunity to take advantage of options, which are freaking amazing. But again, if we look at just some of the earlier chapters in the technical analysis parts of the second part, looking really at moving averages and MACD chapter 31, that was kind of the basis of this trade. And I highly recommend that you guys do finish the second part of this book before coming to this masterclass. This is going to allow you to get some of those fundamental concepts locked in before you actually go and start to apply because the application is awesome. I know a lot of you guys got the audiobook, which is sweet, so if you don't have it in the mail yet or whatever, just go through some of those second parts and look at some of the photos, and that should really help you a lot. So with this stock, things at 20 bucks, I buy a put at 22.5. Now, very basic stuff here. Calls and puts, okay? Easy stuff. There's a very basic chapter on options that is like chapter 21. But the point with it is calls, you think it's going to go up. Puts, you think it's going to go down. So calls, you buy a call. It gives you the ability to buy at a price, and then hopefully it goes above that price. Same thing with puts. It gives you the ability to sell at a price, and hopefully it goes below that price. You can sell below or sell above the market price, or buy below the market price for calls and puts. And we'll talk a bunch more about this in a second. I just want to give you a quick teaser here. So here's the cool thing with this trade on flowers. These guys go from about 22.5, which is where I bought, down to here to 20. And when they're at 20, I'm like, awesome, this is it. This is the dream. I see it reversing, and I see the moving averages so low down here. And it's cool, right, because they're pushing up against the Bollinger Bands, and they're really high up there. And obviously the Bollinger Bands, I mean, they can't just keep going against them forever and ever. They broke out here, they broke out here. They just kept going. And that's when you know it eventually is going to be a retrace. So what did I do? I looked at it and I said it's about a 4, 5, 6 month time period. And that's something we're going to look at a whole lot more in this course, is this idea of time frames. Because you got to remember, with options, you're looking at a time frame, right? So it might be 6 months, it might be 1 year, it might be freaking 1 month, might be 1 day. I've traded 1 day options before. You got to remember, these have application in swing trading, which is sort of like the medium term investments, and then 9 to noon trading, which is that very active management style. But what we're going to really hone in on here and focus on is that application on swing trading, at least at the beginning, because that's really where options shine. Because with 9 to noon stocks, most of those stocks aren't going to have options tradable for them just because of their price range and just the kind of company that they are. And if they do have options tradable, they're generally pretty liquid. Don't worry about any of these terms if you don't understand it. We're going to go into all of this a whole bunch later. It's not a huge deal. So with this trade on flowers, okay, I put in a put option right here. And I say, look, I buy the put at 22.5, and I'll talk a little bit more about why I picked that specific strike price. That's called the strike price, right? So remember, we talked over here, calls and puts. Calls let you buy, puts let you sell. So your call is going to let you buy at a certain price level. Your put is going to let you sell at a certain price level. That price level, very basically, is called the strike price. So my strike price at 22.5, and we'll talk about why that was just later as we get into options pricing. But the cool thing is, this thing actually goes up and up. And in the course of a month, you know, you're wrong initially. And a lot of times, and I mean, I'm wrong a lot of times initially on a trade at the beginning portion of it. A lot of times it takes a little bit of time, takes a little bit of momentum. So it goes up here, and I'm a little bit break even. My break even point on this trade, based on the options premium, right? What did I actually pay to take advantage of this option? That break even point is right here at about $19. So I know that my upside here is probably to about $13, $15. My downside is everything, right? So here's the really important part that you want to understand when you start to go into options is you risk everything. If this option gets to expiration was in like 6 months. If it gets to expiration in 6 months and the price is, this was a put, right? So it let me sell up here. If the price is way up here at 30 bucks or something, and I have the ability to sell at $22, that's not worth anything. It's going to expire worthless. So I paid, what, 500 bucks for this position? So I would have a worthless, that would be just disappear. That money would just vanish if I held it to expiration and it went all the way up here, it would be completely worthless. So that's sort of a concept we're going to talk a whole lot more about as we get more into this course, is this idea of this is a totally separate investing game. And I want to show you guys the exact methods, strategies, and secrets that I've seen literally 100 millionaires use to make the best possible investments in this space and absolutely freaking crush it. So is that awesome? Is that cool? Does that sound great? Hope you guys are pumped for this course because I cannot wait. So I'm going to finish up this trade, and then I'm going to talk about the number one problem I see with so many options, courses, books, information out there, just a lot of crap. And I'll tell you what, guys, I've sifted through a lot of crap learning about stocks, investments, assets. I lost so much money because I had bad information. And so I want you guys to understand there are years of experience going behind everything I'm going to teach you in this masterclass. And the point of it is so that you don't have to make those mistakes and you can get the right information only, and apply the right information as fast as possible to start making money. Now, sound cool? Sound awesome? All right, sweet. So let's break down this trade. It was actually really a fun trade. So it goes up here to 225, and look, you gotta keep your cool. You gotta be chill with it. You gotta remember, a lot of the time, you might mess up in the short term, you might mess up temporarily, but you got to let it work itself out, and that's exactly what I did here. So just relax, chill out, and we're gonna talk a little bit more about what to do when a trade goes south in one of the later modules. But the important thing to hear is just a quick case study, cool example that I thought was just super fun. This was a really fun trade. So it gets up here to 225, and then it bounces down, and then what happens? About a month after I enter the trade, this is about a month, what happens? Flowers reports earnings. This is huge. I've made so many options trades, specifically like when I talk about these one-day options trades or maybe one-week options trades, those options trades are based almost always on earnings reports. Earnings reports are absolutely amazing, and we're going to talk so much more about them and how you can use this very specific event combined with some really awesome option strategies to make a ton of bank when earnings season's around, because earnings season is the most fun time of the quarter, most amazing time of the year. It's just amazing. And if you guys, you've read 9 to Noon, or you're reading 9 to Noon, you're going through it right now, once you start to trade stocks, once you start to invest, you're going to understand exactly what I mean by this, because earnings season just makes your whole portfolio just have a lot of fun one way or a lot of fun the other way. And learning to master that, getting the edge on your trading and making the most profit possible with the least downside is something that I'm completely addicted to and absolutely love. And I hope I can kind of transfer it to you and help you make a bunch of money by copying me, everyone out there that's absolutely crushing it. And that's the goal, is that you mimic those who are doing it and just do what they're doing, which is super cool. So our reports earnings, and here's the deal, guys. These guys, they're pretty seasonal, okay? Pretty much everything they do is based around like Mother's Day, Christmas, Father's Day, maybe, and then I guess like birthdays. But a vast majority of their business comes around in the earlier times of the month or the year, and that's especially around Mother's Day, because I mean, they own a bunch of subsidiaries, but their main business is selling, flowers, chocolates, candies, stuff like that, aimed towards romantic gifts for Valentine's Day, Mother's Day, stuff like that. So their earnings report, this was Q3, right? Their earnings report for Q3 is pretty much always just garbage. I mean, to put it into perspective, I'm pretty sure they double or at least 1.5x their workforce during the holiday season because they need more people because they have more business, and then they just fire all of them from seasonal work. So that kind of shows that, fundamentally, and then this is another big concept, this idea that with some of these swing trades, these are swing trades on options. These swing trades, you need to understand fundamentals, and that's why you have the entire first part of 9 to Noon, and you also have some more advanced video training and modules and lessons that will be around here, which is super cool. So with this trade specifically, it was awesome to see these. I mean, basically, they did what they always do. It was Q3, they tanked, and they just busted out. So they go down 10% in the first day. Now, I want you guys to understand that for a moment. 10%. Now you have a normal short position here. You make 10%. That's 10%. That's that. That's cool. That's it. What else are you gonna do? That's awesome. With an option, my position went up 44% in one day when it went down 10%. But I want you guys to notice and learn and adapt here, and this is the power of options, is that these assets are highly leveraged investment vehicles. And what that means is you can make a lot of money really quick, and you can lose all of it if you're not smart. And so what I want to show you in this course is how to make a lot of money and not lose it. So does that sound awesome? Does that sound cool? Now get this, the very next day, these guys go down another 10%. What's that mean? It means I made 80% in 2 days. That's what it means. Took my profits, I was happy with it. If they keep going down, I got out at about 15. If they go down to 13, they go down to 10. I will be happy to buy a call option and ride them on the way back up after they bounce off these moving averages and have a tremendous season coming up. But I just want to give you a perspective on the trade here. Remember, this stock went down maybe 22%. But my profits on it in a very, very condensed period of time were 80%. 80+%. I mean, just absolutely killer trade. And that's just sort of the surface of what you can do with options. And I mean, you could have done way better than me and just shorted it or bought a put option right when it was earnings day, right? That's a very, very, very great strategy that we're going to talk about a whole lot more. But I just wanted to get this introduction in and show you guys the baseline power of this asset, this investment vehicle, and just the overarching image of options. It's something that you can really take advantage of once you get a handle on technical analysis, once you understand the fundamentals, and that's everything that's in 9 to Noon, and that's why I wrote this freaking book for you guys, which is super cool because now you have it and you can read it. What? That's awesome. So yeah, there you go. Now, before we end this lesson, there's one thing I want to go through, and it's something that really, really bothered me a lot when I was getting into investing, when I was getting into the markets, and specifically a long, long, long time ago when I was trying to learn about options before I really understood the fundamentals of asset management. And it's what most people teach when they teach options, and it's a serious problem. That's why I want to go over it really, really quickly before we transition over to that next module. Almost every single course I've ever seen on options, they all include the same information and start the same way. And it all comes down to the Greeks. Delta, gamma, theta. Look, guys, I've been trading options for a long time. I've done really, really well with options. I've done really, really well with stocks. I've done really, really well with cryptocurrencies. Getting more into bonds, they're super, super cool. Not necessarily my risk portfolio, my management right now. But I've done really, really well with ETFs. I've done well with a lot of assets, a lot of derivatives. Never have I used any of these ever because they are total crap. I think this is stuff that, like what I want to focus on here, guys, is that 20% that's going to give you the 80% results that you want, all right? I want to start making money with you. You got to start making profits, and then you'll learn as you go. You can learn that last 4%, that last 3%, that last 2%. It's going to give you just a little edge. Because, guys, this stuff, I've never used it, and I've been freaking crushing it with it. It doesn't matter. I don't want you to fall into the trap of trying to learn 100 million, 1,000 things all over the place. Because that's what so many people are selling. They take this very, very, very simple trading situation, and then they break it into like 10,000 bullet points of everything you need to do. Like, I'm going to show you. This was a very, very, very simple trade. What happened? It bounced off of a moving average. I bought it off of a moving average. And I sold it because it was going into the Bollinger Bands and it was freaking super high and it just doubled. Okay, doubled my money on that trade. And then I shorted it. So all the moving averages were down here. And you guys are going to learn so much more about these technical indicators throughout this whole 9 to Noon Secrets area. I mean, it's so powerful. But like, guys, I was not looking at the Greek letters of the alphabet or of trading or of options. Like, it doesn't matter. Once you guys get a fundamental grasp on technical analysis, those 2 words, they freaking changed my life, and they continue to change the lives of so many students. That's the background that you're going to want. That's the basis of all the trades we're going to make. And I'm going to show you that. My goal is to convince you that you can trade options and crush it the moment that you master technical analysis. Understand the fundamentals of asset management, of stock trading, because these options, they are very, very, very powerful investment vehicles, but you need to understand how to trade and how to invest before you get into them, because like I said earlier, high upside, leveraged upside means you can lose everything if you mess it up. So what I want to do is make it so you don't mess it up. Does that sound cool? Sound awesome? Sweet. Thank you guys so much. Hope you've enjoyed this introduction. I can't wait to get into this course. It's so, so, so great. And I'm super pumped about it. So I will see you in the next module. Thank you so much. And hey, there should be like Facebook comments below some of these lessons. So hey, if you see up like super cool trading stuff, or you have an awesome insight, you're like, wow, this was awesome, dude, let me know. Let everybody else know and start talking with people, start connecting with people. As an advantage for grabbing your copy at 9 to noon, you guys got access to a super awesome Facebook group. And this is really one of those places where you can start to network with people or grow with people. So like comment below, or just connect with some of the members of the community, because I want you guys to get the most out of your education here. And one of the best ways you can do that is connecting with other people that are in the same learning process that you're in, and just talking to them and saying, hey, what are the investments you're making? What are the platforms you're making? What do you think about some of these trades? As soon as you can do that, as soon as you can leverage other people, you're going to skyrocket your success. It's something I really, really, really wish I had when I was learning, because I was learning everything on my own, and that was a really tough place to be in. So what I'm trying to give you is every tool possible that you can need to succeed, so that you have massive levels of success and want to stay with me for the rest of your life. Now, not saying it'll happen, but I think I can make it happen. So take notes, have fun, and apply the stuff we're learning here, and you're going to absolutely crush it. All right? Thank you guys so much. I'll see you in the next module. Have an awesome, awesome time. See you there. Thanks. All right, awesome. So one of the first things I think we really need to break down is how options are priced, because you can understand the price and the price breakdown and the price movement of an asset, then you can make money when the price goes up. Now, it's a little bit easier with stocks. With stocks, if the price goes up, you make money. If the price goes down, you make money. With options, it's a little bit different. One of the biggest things that matters with options is this idea that they have an expiration date. So if you buy an option and maybe you want to buy a call at this price level right here for whatever stock this is, the price of the call is obviously going to depend on the current price of the stock, but it's also going to depend on the expiration date, right? So if you want to buy it and you're right here and you want to buy it right here, if it expires in a week, it's going to be worth a whole lot less than if it expires in 4 years, right? And so the longer time period you have, the more the option is going to be worth, because it has more time to get to this price level right here, and therefore it has more time to break even, which means you have more time to create a profit, to go into the green, right? So if you think that the stock is going to absolutely crush it over the next 3 or 4 years, a lot of times you'll see options where maybe it's a $10 stock and the option will be like $5 for the next 4 or 5 years. So you're paying about half the price of the stock to get a chance of the upside when it gets to this price level. But at the same time, you're risking all of your initial investment if it doesn't get to the price level. So what I really want you guys to understand when you go through this module is that options are basically not for long-term investments. If you're going to hold anything more than a year, maybe like 2 tops on a small volatility stock, I mean, anything past a year, I've personally never traded an option for, just because it doesn't really make sense. You don't know, a lot of times with these swing trades, they're a little bit less predictable than 9 to noon trades, especially once you start to get past that 6-month, 8-month golden time horizon. That's really what I found to work the best. It's about 6 to 8 months for a longer term options trade. Now, I'm not saying it has to be 6 to 8 months. Really, really great trades are possible in a time frame of 1 month. Really, really great trades are possible in a time frame of 1 week. What I really like to use options for, and this is something that might depend on where you're at and how much time you had to invest, but I like to use options for swing trading and magnifying my returns, specifically with about 4 to 7, 8 month trades. Because usually those trades, maybe if it's going to go up 30%, it would yield me 30%. But with options, I can kind of leverage that up, right? So I'll make, triple figure percent gains, make hundreds of percent points without necessarily having to have a massive movement in the underlying stock. Because a lot of times, especially if you start to trade pricier stocks, the actual movement of the company is a little bit slower. And this has to do a lot with floats, and we'll get to floats a lot more very soon. But the point with it is that as you look at a longer time horizon, it's more expensive to actually buy. And the more expensive the stock, obviously, the more expensive the option. So that's another important factor. Volatility, obviously, guys, if this company, instead of having a chart like this where it's nice and stable, you just kind of race that away and we look, maybe we say this is like an absolutely crazy stock. So if you look at a company, maybe like AMD, right? They're going up and up and up, bam, and then they go down and down and down, and then they go up and up and up. This is a very volatile setup, a very volatile pattern. So options prices are accordingly going to increase because the volatility is higher. And the premium is what you're really going to pay for the option and the total control of the option. The premium is made up of inherent value, time value, and obviously volatility, expected volatility, implied volatility. And this implied volatility is a really, really important measurement, volatility, that we're going to look at more throughout this course. But this is a really, really important concept that we're going to break down a ton more when we look really at some of those overarching volatility indexes like the VIX. So we'll get to that pretty soon, but that's an important part. Essentially, what you're looking at is if the strike price is at 20 bucks and your call and the current price is at, say, 20 bucks as well. They're the same. Okay, the inherent value is $0, but the time value might be very large. If it's maybe a 1 year option, 1 year call per se, it's going to be worth a lot more than maybe just a 1 week call or a 2 month call. So if you have a whole year to actually exercise it, a whole year for this to keep going up, a whole year for this price to change, all of a sudden that becomes worth. So this has some inherent value in the time value. And then the other thing is expected volatility, right? So if you look at this chart, this is pretty freaking volatile. So if AMD, if it chilled out and it just kind of went sideways and it never really moved anywhere and it was very, very, very stable, obviously you can see this expected volatility value be pretty low. But if we look at how it's performed recently, historically, just as an example, a very high volatility, thing freaking tripled in like a year, it's going to have an increased expected implied volatility. So you're going to see this right here start to increase in price. So these can get pretty pricey, but the point with them is that this premium is significantly less than the actual cost of ownership of the stock. So for example, the AMD, instead of paying $30 a share, might pay $2.50, $3 to control a lot of shares. So very cool concept right there. And specifically with stock options, very important point here when we talk about leverage and we talk about value, and we talk about pricing, we talk about the actual cost of owning an option. If you want to buy an option for a stock, you're going to have to buy an option times 100 shares, right? So when I say it costs $3, it's going to be $3 times 100 shares. So you would have the ability to control 100 shares for $300. And then if the shares go up, from 20 bucks to 26 bucks, something conservative, I mean, they've done that a whole lot, then you're going to make $6 per share. $6 times 100 shares equals $600. So at a very fundamental, rudimentary level, you really want to look at your potential upside in dollars and then compare those dollars, that upside profit, with the actual cost of the option in dollars. And we'll look a whole lot more about actually figuring out what this number is when we look at technical analysis and the indicators and setups you can use to accurately predict this and set up solid risk to reward ratios so that you have excess profits with minimal downside and you win more and more trades, or at least make more money, because that's what it all boils down to, is minimizing downside and maximizing upside. So really cool concept, and it all stems from this idea that the premium is what you're going to pay when you go to buy an option. And that premium is affected by inherent value, time value, and implied volatility. Now, what's really cool is that in 9 to noon, I actually shared with you the freaking coolest chart on this planet. I'm going to redraw it now because it's super important in understanding this volatility and time value of an option, which is the most important part that you're not going to tell just by looking at the inherent value, right? The inherent value, I mean, it's pretty basic. If your strike price is at $23 and the stock is at $20 and it's a put, so it lets you sell, if you can sell 23 bucks, inherent value is $3. Very basic concept. Same thing with a call, okay? The price is at $20 and the call is at $17, it has an inherent value of $3. But this time value and this implied volatility is a powerful concept, and it all really comes from this idea of options value versus time. Now, this is a concept you have to understand specifically when you're looking at like 1 year trades, 6 month trades, 8 month trades, and you'll see it a lot if you have very, very short term, like 1 week trades, because the cost of the option will change dramatically. It's a lot cheaper to buy a 1 month call than it is to buy a 1 year call. Very basic concept, but for a stock that's $30 like AMD, or whenever you're watching this, it might be freaking $100. Who knows? I don't think it'll be $100 just yet, but we'll see. Um, it might cost $3 to buy a yearly option, but it only costs 30 cents to buy maybe the next 2 weeks for an option. And we'll talk a little bit more about the option time frame soon, and we talk about it more in 9 to noon, but it's a very, very basic concept, not too difficult. We'll get to it in just a moment. But what I want to look at first is option value over time. It starts out really high, right? So if you have a lot of time, you're going to have a lot more value than when you have a very little amount of time. So if we look at like days till expiration, so it'd be 0 days till expiration. This, and here it's 100 days, but you can just make this really any number you want. The more days, the bigger the value is going to be. Very simple concept, but very powerful concept. So it starts out really high, and then it goes down and down and down and down, and then it kind of gradually just paints into zero. And that's kind of the importance of understanding your position, understanding really where you're coming from with these options, because the goal with this is to play off volatility. And the best way to play off volatility is by playing off technical setups and indicators, and that's everything we're going to talk about very, very soon. But you want to make sure that you have setups that are going to move quickly, because this time value decreases fairly rapidly, especially when you get to start to this, this last quadrant over here. It starts to go down pretty quickly. So you want to make sure that the setups you're trading, they go through quickly, they execute fast, so that you do make this $600 profit, or adding the zero to it, 6 grand, 60 grand, 100 grand, 6 million. The really cool thing about asset markets, financial markets, you could have the zero on it, 60 million, 600 million, 6 billion. You can add as many zeros as you want, especially with options, because this stuff is infinitely scalable, infinitely up and up and up and up. You take it as far as you desire. It'll just keep going. That's what's cool about this. Take your profits, instantly reinvest them. Up your position size, as long as you have the fundamental skills at the basis of your investments, you can scale this to make as much money as you desire. A very powerful concept, and it's something I'll talk about so much more in the Think and Grow Rich course, about like setting your goals and your passions and your desires and your dreams. And I'm sure a lot of you guys have gotten your hands on that. If not, it is special offer for new clients only. So we'll see if it might be in the membership area. Totally up to you. But that stuff changed my life. So awesome. And it'll help you with this, because you want to keep increasing your trade size. You want to keep increasing what you're doing, the value that you're bringing, and the best way to do that is up that position size over time by reinvesting profits, so you can continue to compound and compound and compound. And obviously, we'll talk a little bit more about that as we discuss compounding in some of these classes and master classes. So a lot of really cool stuff there that all stem from this underlying principle of options premiums, right? So you want to make sure you understand at a very basic level the cost to get in is based on inherent value and time value implicit volatility. So if you're looking at the price and there's a discrepancy between the actual value and the price of the option, which is something you're going to see once you start to trade, once you start to buy, remember what it's based off of and use it to your advantage. You want to trade the stocks, the assets, the derivatives, the currencies, whatever you're trading, you want to trade the assets that don't really have a great options premium pricing. So for example, if you look at a trade and say it's a head and shoulder setup, right? So you have a really, really, really nice head and shoulder setup, okay? And like there's a pretty freaking good chance, and we'll talk about this setup in a second, but I just want you guys to understand the principle here. You know that there's a really nice chance that this thing's gonna go down. But the call options are like, say this is a $50 stock, okay? The call options are $5. And the put options are like $1. And so you'll find these examples in the marketplace where, and this would be like the same price. These are both strike price $50, right? And you can have way more profits by trading the right way. So this is an example, right, where you would see that, wow, the expected time volatility is very, very, very low for the way that you think it's going to go, right? So for this example, you think head and shoulders usually means it's going to go down, right? So you want to look for examples and trades and setups where it has an asymmetric risk-reward ratio, and you're making a lot by risking a little. Minimum setup for a lot of these options trades, especially the ones I do, I really try to look for about a 3 to 5 risk-reward ratio. I don't want to be risking more than $1 to make about $3 to $5 back, and that's a setup and an indicator and just so much more that we'll get into soon. And the best way to get to that point is to use the power of technical analysis, setups just like this, indicators that go alongside this, so that you can find these trades where it's much cheaper to get in and then make a ton of money. So if this thing goes down to 40 bucks, I mean, I made a trade very similar to this with Wells Fargo. Wells Fargo, they were at like 65 bucks, and they were in head and shoulders just like this. I shorted them down to 45 bucks. I mean, that's 15 bucks a share. So if you put $1 in an option, and I would usually short maybe this shoulder here, so I think I shorted it like, sounds about right, making 15 bucks for every dollar that you risk. That's a very great setup right there. You take that trade 10 times a day, you'll absolutely crush it. So that's what I want to help you identify here. That's the point of this course. That's the point of these modules, is especially when you're starting out, if you don't have as much capital to go with, you want to be careful and you want to understand what you're doing and you want to learn. But this is a really good way to grow cash quickly once you know what you're doing. You got to know what you're doing. I highly recommend that you at least take a couple of days to trade 9 to noon before you go into some of these riskier investments, because like I said, you put 100 bucks in here, you know, whatever you're trading with can lose it all if it doesn't go your way. If this thing goes back up and it expires worthless in 3 months, then you're going to be out of the money. So it's a very delicate investment vehicle, and it's awesome that you're here learning this stuff, because it means that you can take advantage of it and have the best possible chance of succeeding and go out there and absolutely crush it, so that you're doing the right steps to get the right results to make a profit in the marketplace. Very powerful concept, and you're doing the best thing you can do by being here, by learning this. That's really going to be your path to take the quickest possible path to have profits in these markets and to absolutely crush it. So hope you guys got a ton of value from this module. Go out there, crush it. Make sure that you understand premiums. Very simple. Log into your broker. If you guys haven't seen you know, some of my top brokers, just 9tonoonsecrets.com/brokers, and it'll tell you sort of up to date, current, what my recommended brokers are. Look and see where you can trade. So just pick some of your favorite stocks, any stocks that you have in your portfolio, and see if you can trade options. You can't trade options on all stocks, but if you can trade options, they're regulated by options exchanges, stuff like that. You want to make sure you can't trade them all, but see if you can trade options on one of your favorite stocks, and then go out there and look at the premium prices, especially over time. Like, pause this video or finish this module, and then go into Yahoo Finance. You open up any stock on Yahoo Finance. All you have to do is a little tab at the top, and there's a button that says options, all right? Click options, and that's going to show you all the options. It's going to show you the full options chain, so you can actually see these premium prices in real time, and you can understand, hey, if I bought this, you know, a month ago at $1 and now it's at $3, I would have doubled my money. Why is that? How did the actual underlying stock move? Remember, all of this is based on underlying price movements in the stock, underlying setups in the stock, underlying indicators in this stock. And that's why when we look at using the insane power, these two words that just changed my life. Look at technical analysis. Technical analysis is going to be your gateway into really crushing it with options, because everything's based on stock price, and you can predict stock price extraordinarily well using the power of technical analysis. These techniques, these strategies, these two words absolutely changed my life, and I just cannot wait to get you learning more about this and into part 2 of 9 to noon and in some of the extra little trainings we do here, because this stuff is profit. This is money. I mean, this is learning how to print money from the most powerful economic machine in the world, and that is the American equities market. Very cool stuff here, guys. And remember, this is going to be applicable across all asset classes. I've seen these setups in crypto. I've seen them everywhere. You got to remember, though, when you look at, you know, stuff like currency, stuff like forex, stuff like crypto, a lot of these aren't as regulated as U.S. stocks. So these options, right, they go through centralized options exchanges, at least as of recording this video, right? So you just gotta go under Yahoo Finance and click this little options tab and see if the stock that you're interested in actually has options. And most 9 to noon trades, they don't actually have options. Very small part of them. Some of them might have options. So just look around and understand that not all stocks are going to have options. So you want to make sure that you like actually find the ones that do, and then trade them very, 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 very well. And that's gonna help you absolutely crush it and multiply those returns once you understand how to create the returns in the first place. You got to get that fundamental basis down, and that's the exact purpose of all these trainings, is so that you can have that success. Because it all stems, option value. It doesn't matter if time value goes from $1 to $0 if you can't make a trade that's going to make you $2, $3, $4, $5, $6, $7 on every dollar that you bet based on the inherent value. That's really the game here. The game here isn't really to try to time the timing or game the timing. The game here is to have fundamental growth and actually predict the price of the underlying stock and profit by taking this profit right here. And you would originally have to put up 45 bucks or 50 bucks to actually short this stock, or if you were going to go long, you'd have to put up 50 bucks to actually buy this stock. And instead, since you have a compressed time frame, and specifically using technical analysis, you can actually know very, very carefully how long the trade's going to last. And we'll look at this concept more and more and more as we get into some of these setups. But once you understand how long a trade's going to be, you look at an option, maybe you add 10, 20%. So if I think it's going to take 3 months, I might have a 4-month, 5-month, 6-month option just to be safe, cover my butt. Because it's not a huge difference, right? It might be a 20% difference between a 4-month option and a 6-month option pricing-wise. But for me, an extra 2 months, that gives me a lot of extra time to play with. And with flowers, it took me about a month to make a ton of money and sell that option. But that was a 6-month option because I knew that they could crush it for a month or two, and I wanted to have my safety. And the difference in pricing was like a couple $100, but it was well worth it because it gave me that flexibility, and you have the same profit either way. It just affects your risk-reward ratio because you're putting out more capital in the trade. But relative to the actual price of the stock, right, like $50 stock, you put down $5 to have control of it. I mean, $5, $7. Those are both very nominal amounts to control this stock if you know that you can make, $7 on the downside or $15 on the upside. Whatever it is you want to be looking, if I'm putting down $5, I would like to make at least $10, $15 so I have a 2, 3, 4, 5 risk reward ratio. Because remember, you are risking pretty much everything you put down. So you want to make sure that that upside potential is there so that you have the biggest trades possible. Because remember, the basis of a lot of investing is don't lose money. And with options, you're really on a fine line of losing money. And something that will happen a little bit more often with these positions just because they do expire. And I've had a lot of trades, especially with these shorter time frames. If you look at like 1 week, 1 day, 2-day options, these are sort of the assets that can go to zero. They can go to nothing. They can go crash and just zip. I mean, I've had options where I was trading GE pre-earnings, and GE has been an amazing, amazing stock. I bought them at like $7, it was like $11, $12. I mean, they've just been crushing fundamentally. They've been awesome. I have them just as a normal stock. I started to trade options on their earning dates, expecting them to have sort of that big bang, that big boom, that big shift. And I'll show it to you real quick just so that you understand kind of where I'm coming from. But the basis of it is like you can lose it all with options. So as you go into these next modules, I want you to focus on taking what I'm saying and then thinking like, well, how can I apply this to make guaranteed profits? Because the instant you can make guaranteed profits, you're above 99% of investors, because most investors are just looking at a chart and they say, oh, it's going down, oh, it's going up, oh, I should probably, buy here, oh my God, my emotions are taking control of me and I want to sell here. Most people, they're buying low, or they're buying high and they're selling low. And that is not the strategy you want to be employing. That is the quickest way to go bankrupt right there. Because emotion, and we're going to talk about this so much in the emotional mastery section or the module somewhere around this training area, because that's a very important concept. But the really, really cool thing, and specifically with GE, and then we'll move on to the next module, they've been just crushing. I mean, really, really great gains. And so I see this and I say, wow, well, I'm going to buy a 2-day option for the earnings report. And I would see, here's the important thing. You want to remember that you make 10 trades, 6 of them crush it, 4 of them suck, you're in a good place. You can have great returns with only 2 of those trades, but if those 2 trades make 400% and they cover the cost of all the other 8 trades, then you can still make a ton of money. This is something we talked about in 9 to noon a little bit later in the book. This idea of the profit trifecta, right? And understanding at a fundamental level what needs to happen for you to have portfolio growth consistently and well, over and over and over and over. And this is, you know, a powerful concept, and it's something that every single setup in this masterclass focuses on, is this idea of consistency, win rate, your average profit loss. And as soon as you can increase this profit 10 times more than your loss, you're going to absolutely crush it. I know it's a little bit out of the frame here, but the important part to note is that if you're making 10 times more than you're risking every single time, you're going to crush it. You're going to go out there and hit it out of the ballpark the more trades that you make. And so the basis of actually accomplishing this is technical analysis. And that's the foundation. That's the baseline of what I'm teaching. And that complements the fundamentals. Specifically with this trade in GE, this was a very heavily influenced fundamentals trade. Okay, everything here was based off of this idea that the company had just hit a massive bottom, and they dropped from like 30 freaking bucks to this huge low, and then they're like going through this corporate refinancing and restructuring and just a whole lot of growth and change in the way that they operate. And so that was really what got me to get in here, is I was like, and if you actually looked at it, it was actually really, really cool. I'll show you it on over here just so that there's a little bit more space. This stock went up a whole bunch in like the 2000s, then it went down a lot, then it went up a whole bunch in 08, then it went down a lot, then it went up a whole bunch, and then it went down a lot. Now, what's interesting is if you look at this position, you start to see the same thing happen over and over and over and over again. It goes down to this price level right here. Now, let me tell you guys something. We're going to look at support resistance in just a moment, and we've taught it before. I want to apply it to options here. But if you see it bottom here, and it's bottoming here again, what do you think is going to happen? Let me tell you what happened. It went from $7 to 12 bucks, 11 bucks. Like, I think it was 11.50, 12 bucks. It just absolutely crushed it. Now it's at like, what, 9, 10 bucks? I mean, it just depends on when you're watching this video, right? But it's a cyclical economy. It's a cyclical stock. This is an energy stock, right? So very, very, very basic cyclical setup. And that's what I was trading here. And so my expectation was, since these guys were in a reversal, right? They're going up and up and up and up and up in a reversal. This earnings report right here would actually help them go up a lot. So they dropped to like 10 bucks. So it would help them go back up, make a new high, and absolutely crush it. So what I did was I bought a call at 10 bucks that expired in 2 days. And they report earnings. The earnings were, whatever. But it was kind of a flop, And so the stock goes up like 5% initially, and I'm up a whole bunch. I'm trying to get my butt out of there and sell because it was a short-term position. And so just it flops down after that. It just goes down, treadles down, and it kind of stays flat. And that's the thing with options. If it stays flat, you lose money. Because remember, this options premium, you're paying this price. So for me, the option premium was like 50 cents. So I had to get it to like 10.80 to break even. And it didn't get to 10.80. It stayed at like 10. It was 10.80 initially, but then just kind of bounced back down to 10.50, 10.20, trailed off. And then after 2 days, it expired worthless. So in day one, I saw the value of the option decrease by 45%. And in day two, it went to 0. So when you're trading your positions, make sure you know that this stuff can burn your cash and it can multiply it at the same time. We were right at the end of this value curve, right? And so it was losing value very quickly, since the time value was really the only value to it. Because inherent value is 0. You don't reach that break-even point of the options premium versus the strike price by the time you get to the end of the trade. And this is a very basic concept that you're going to see a lot more once you start to actually make your first trades. Because you're going to learn a whole lot about the fundamentals of trading. I mean, all you really have to do is make that first investment and just make it like a $10, $30, I don't know, freaking cheapest you can probably get. I've seen options. You can get like a lot of 100 shares for like 10 bucks. So just make that first trade and start to understand how this actually works out. The best way to do it is to just do it, okay? So with that said, trails off, doodles away. That's the point, right? Is that you're not always going to win with options. And if you lose, you got to be prepared to lose. There was another position in Texas Instruments. Texas Instruments, they reported earnings on a very, very, very close date to GE. And when they reported earnings, a little different situation came out. See, I was not particularly aware of the earnings dates. I will tell you what, I was slacking. That's what was happening. I was just a real big slacker during this earnings season. And so what happened was I didn't really know that like Texas Instruments was reporting earnings, which is freaking stupid, because Texas Instruments, for those of you guys who don't know, I would highly recommend you read their annual report. But basically, all Texas Instruments does for about 99% of their business, or at least 80%, like a vast majority of their business, is wholesale semiconductor manufacturing. So they make like semiconductor chips for companies, and then they sell them, and they produce consumer electronics. Other companies produce consumer electronics. Most of their business is not what most people know them for, which is the Texas Instruments calculators. Calculators are they're like 2.5% of their company, of their revenue. It's a very, very small percentage. But most people, they think of TI and they think of the calculator. So as you look at them over time, they usually do really, really well in Q3 because what happens in Q3? School starts, right? So over time, Q3, and then this was this Q3, they do really, really, really well. At least historically in the past couple of years, past 10 years, obviously do your own research and look at this stuff. But Q3 does well because public perception, people think that everyone's buying calculators. And even though that's not necessarily true, what moves a stock is buying and selling in public perception and supply and demand. So if more and more people think that they're selling a bunch of calculators and they think that the stock price can go up, well, what do you think happens? Let me tell you what happens. Last earnings report, they go up 25, 30, 40%. They go up 40% in one day. I mean, that's big. That's huge. That's massive. Now, I want you guys to understand this from a long-term perspective and from an options trading perspective, because I'm in TXN long-term, right? And I'm like, sick, dude, that's awesome. But get this, okay? And this is the power of those very short-term options, because like we talked about earlier, the options value is very, very, very low once you start to get to that last little bit of the contract, right? So that last week, that last couple of days, that's when you're going to have very, very cheap options. With Texas Instruments, they had an options contract that expired one day after they reported earnings. And oh my God, I can't believe I didn't buy it. I feel like an idiot, but the options contract was like 7 cents. And NVIDIA is a $100 stock at the time. Now, even if it was like $1, you're putting down, what, 1 times 100 is $100. And the stock goes up 20 bucks. 20 times 100 is $2,000. The thing went up 6,000% in one day because it was priced so cheaply, because there was so little time value and absolutely no inherent value. Until the inherent value went from 0 fractions of a penny to hundreds of percentage points, thousands of percentage points, as it added $20 to a base of like 2 pennies to buy the option. That trade made a lot of people very wealthy very quickly. Why? Because options are leveraged investment vehicles. And while my trade on GE, the earnings report was slop, if I made 10 more of those trades and one of them was in Texas Instruments, that would have more than made up for each of those individual losses. So if you can just get one huge winner, it can pay for and profit above, 10 losers. So that's the real goal here. At least that's one strategy, is to just aim for home run trades. And, try to make, singles and doubles along the way for sure. Definitely try to get solid, high quality, great percent chance setups. But remember that just one really, really, really good trade, when you're just one trade away from thousands of percent gains, you put $1,000 in there, that's 2,000, put another couple of zeros on it, that's $200,000. Those of you guys who don't know the perspective I'm coming out with this, when I was trading cryptocurrency, and still trade cryptocurrencies obviously, but during the bull run of 2017, I was in these positions, and I pretty much turned about $400 into like $40,000, and I had a lot of positions where they basically, it was like $100,000. Now obviously I lost $100,000 as well during the crash because I didn't know what I was doing. I didn't have the right setups, didn't have the right education. But like, you guys got to understand, you can seriously turn a very small, finite amount of money into a lot of money really quickly with the power of capital markets. When I was turning, a couple grand into $100,000, I did that entirely. Cryptocurrencies, obviously, there weren't options, right? So that was just with normal investments. So I want you guys to understand that with the power of options, what you have in the stock market is like a 2-punch combo. And as soon as you master the fundamentals and you understand the financial education that you need to have that overarching success, that development and that growth and whatever it is that you're doing, you're going to have freaking massive growth. I want to give you belief here, and I want you to inspire you to look for patterns like this. So with Texas Instruments, they do really well on Q3 usually. Look for patterns like that. Another great example, I made a trade, 2 years ago in Regal and AMC, and Regal and AMC are both really cool companies because for some reason or another, a vast majority of the time, they kind of do the same thing. They're very, correlated stocks. And what was interesting is I looked at them over the years, and basically every time it was December, they went up a lot because, a lot of new movies in December, a lot of increased public perception of movies in December, people going out, families, social spending, people going on dates, whatever. There was a lot of growth in December. So I bought these guys in December, and with Regal specifically, I mean, within 2 months, the company got bought out. I went from $15 a share to $21 at the buyout price. I mean, that's a pretty nice string gain. And I want you guys to understand, I didn't know about options at the time, and I didn't understand this concept that you could have a very finite period of time multiply our results. So I made, $6 a share. That's really, really, really good. I want you guys to think about this from an options perspective and understand that if it costs $1 to control this stock, you make $6 over the course of a couple of months because you have a solid understanding of the technicals. A lot of this trade basis was technicals. It was based on very low stochastics, very low, the moving averages were like way bouncing off the moving averages. It's been a while since I made this trade, but it was definitely based a lot on stochastics, a lot of MACD, a lot of moving averages, and we'll get into those technical indicators and really break down how to trade options with them very, very soon. But the fundamental basis of this trade was based on technicals, and then of course it was this extra part of it was December. Same thing with that trade on Texas Instruments. The fundamental basis of the trade is not just Q3 earnings, but the fundamental basis is actually the technicals, right? And then those fundamentals support it, and the earnings report is the catalyst for the movement. Same thing here. The fundamentals are, it's all based on the technicals, right? And so that's why it's each technicals. That's the most important part. And you make this trade right here. You put down $1 to control the stock. You make $6. That's a 6x return, so $6 per dollar that you risk. That's a really, really, really good thing to do. You do that 10 times, you're gonna crush it, dude. Because it's just amazing what options let you do, because they let you get into these positions that ordinarily maybe you wouldn't be able to afford to do. And I don't say that lightly because it's dangerous. You've got to remember, you can lose all your money. I traded for 2, 3, 4 years before I started investing in options because I had to understand the fundamentals. Now, what I'm giving you in 9 to noon is pretty much everything I know. So this should really, really, really skyrocket your success and shortcut years and years and years of learning. But please, please, please make your first couple of normal trades before you get into options, because remember, you can't lose everything here. And you want to understand, just make your first couple of stock trades, start to get comfortable with technicals, start to get comfortable with order entry and order setup, because we're going to talk in just a little bit about how to actually put in your orders and figure stuff out and make it work. And that's a little bit more complex than just buying and selling a stock. And I'm not saying you have to wait 3 years like I did, because you do have very, very powerful tools at your disposal in this 9 to noon members area and these courses and the book. It's awesome. But you definitely want to make sure that you understand what you're doing. And that's why I have this training for you. And that's why in the next module, we're going to look really more into leverage and then how you can absolutely crush it trading options today. So awesome stuff, guys. Hope you got a ton of value from this training. Go out there, crush it. Have an amazing, amazing day. And I will see you in the next module. Thank you so much. Bye. Great, so in this module, we're going to break down sort of some of the best strike prices that you can use, how to figure out where you want to enter your trades. So when you send your order to your broker, it depends on the broker, right? And that's why I created that section where I show you guys some of my top recommended brokers. But basically, you've got to show them, your strike price, pretty basic stuff, where the heck you want it to be at. And then obviously your bid / ask for the option, right? Remember, we talked about this so much in chapter 19 of 9 to noon, this idea of market orders versus limit orders, and options specifically are an area where you really, really do need to stick with limit orders. See, the deal is options, they're inherently a little bit less liquid than the underlying stock they represent. Specifically, if you look at a normal stock, you're going to see a lot more trading volume in the actual asset than you'll see trading volume for the options, just because there are less people trading the options. So because of that, the spreads on a stock might be a penny, might be half a penny. The spreads on an option are usually maybe like a nickel. I mean, they're pretty sizable. For like a cheaper stock, maybe a more expensive stock, might be $1. I mean, these are going to be like $1, whereas the normal spread might be like 5 cents, 10 cents. So you're looking at larger spreads with these options trades. And remember, those spreads, they directly impact the value of your option. I know a lot of positions I'm in right now, and the option premium is like 70 cents. So a difference of 5 cents is pretty freaking big in that kind of trade. And so you definitely want to try to stick, and especially with, remember, most of these trades, they're fairly, medium-term trades. They're not like you're getting in and you're getting out 5 seconds later. You can do that with some 9 to noon stocks. It's a little bit more challenging, and we'll talk about it a little bit more, but most application of options trading is going to be in swing trading. And so these positions, they're lasting maybe a couple of days, a couple of weeks, a couple of months. So you can afford to put the time in at the end and save yourself 10% on your exit or 10% on your entry at the beginning by specifying exactly where you want to get filled. And just a quick refresher for those who are newer to this stuff. Remember the market depth, obviously you have people that are trying to sell at a higher price point and people that are trying to buy at a lower price point. So for $50 stock, maybe it's $50, maybe it's $50.50. And so this 50-cent spread here is, if you do a market order, which is just a normal stock trade where you push buy, what you're really doing is you're overpaying by 50 cents because you're buying from people that are selling rather than getting in line to buy for maybe like 50 cents, $50.01. And as soon as you can get in just a little bit above this guy, you're going to have a really, really, really good chance of getting filled. But you're going to save, 49 cents. You're going to save just a little bit on that order entry and earn just a little bit more on that order exit. And it's going to help you a lot in the long term to increase those profits sustainably so that you have more profits since you get in a lower price and you get out at a higher price. And obviously the reverse is true. Very short position or a put, anything where you want the price to go down, you're going to see you want to get a little bit better sell. So you sell it for a little bit more money, you buy it back for just a little bit less money. So just make sure that you are actually looking at that bid-ask option pricing. And I know a lot of brokers, some of them, they're a little bit inflexible, and you want to make sure that you look specifically. And this is why I have that whole part where I talk about, that whole webpage where I look at the best brokers currently, because it's really, really, really important that you get a solid fill. Because a difference of, 10 cents, if you have an option, maybe instead of $50, it's $5. And you're looking at a 50-cent spread on a $5 option. I mean, that's 10% right there, right? So if you can save 10% on your order entry, that's going to really, really, really help you get a lot more out of this trade. And it applies up, it applies down. It doesn't matter what your position size is. You should always be specifying your limit price when you get into these trades. And it just keeps becoming more and more important as you increase your account size, as you increase your positions. If you think about, how high your portfolio could grow with just a little bit, like a 1% better return versus, over the long run, minus that 1%, this could be a really, really, really big difference. And, this is like, if you're trading large enough, this is millions of dollars. If you're not, maybe it's hundreds of thousands of dollars, maybe it's $1,000, maybe it's $100. I would just think, wouldn't it be cooler to make 1% more over the next 10 years? Or over the next 10 months, or over however, long your investing time frame is? I think it would be. And one of the easiest and most overlooked ways to do that is to use limit orders. So very powerful concept. Always make sure you're sticking with those limit orders and you're saving just a little bit on your entries and your exits so you can have the maximum profits once you start to submit your orders and when you get out of those orders subsequently. Very powerful concept and a very basic concept that's often overlooked, and that's why it's really, really cool that you guys are here taking advantage of this and learning about it. So strike price, this would be like the break-even price. Not the break-even price, but this is like the price of the option, right? So this is the predetermined price, and that's what we'll talk about later. So predetermined, if it's a call, this is what you buy at. If it's a put, this is what you sell at. And then the bid and the ask, this is the premium, right? So you want to make sure that you look at your break even. Break even, this is the most important part. How do you make money? Break even is the strike, and then plus or minus the premium. So it depends on if it's a call or a put. But I mean, you'll know this, and your broker should tell you this, what your break-even price is. So if the stock's at $50, does it have to go to $55 for you to break even on a call, or does it have to go to $45 for you to break even on a put? That would be a $5 premium. So the strike's at 50 minus the premium. That's going to be your break-even price. So if you pay $5, for you to even start making money, you've got to recoup that $5, and then anything on top of that, anything that goes past this break-even point is just like icing on the cake, right? That's your profit. And that's where you want to maximize your growth. You want to have the most profit possible so you can have the most growth possible, right? More growth you have, higher your break-even is. If you can get more and more and more your option trades to this break-even point and start to profit from more and more of your trades, that's where you're going to start to see compounding growth, compounding profits, compounding portfolio, compounding bank accounts. Everything stems from your ability to make money on trades. And to make money on options trades, you need to break even. That's step one. You start negative, usually since you're paying money for the premium. So you want that to transition into positive by using strong technical setups. And then you want to increase your gain, increase your profit as much as possible so that you have really, really, really good risk-reward ratios and an awesome trading triangle, trifecta, and risk-reward ratio. And that's why it's super important that you know your strike price, you know your bid ask, and you know your break even. Now, here's the interesting part. If we look at typical options, there's a little bit of a spread, right? And so obviously it depends on the actual premium what your break even is going to be. So if I draw just a little bit of a sample chain, I remember this one I'm trading right now, OXY, okay? Trading OXY. And the price goes, I'm looking at them, I kind of want to see it go to like $60, and those sides like $40, okay? But they have options at $50 call or $50 strike price. They have options at 45, 47.5, 52.5, 55, et cetera, right? You get the point. And with these options, obviously, the premiums are different, right? So if the stock, when I got in, it was at $49, right? So it was like right about here. When the stock's right here, the price is going to be lowest for this $50 one right here because it's closest to it, right? It has the lowest inherent value. Obviously, if you're looking at a call, you want it to go up. So these have more inherent value because they already, are worth $5, $7, $2.50. Whereas these up here, they're not worth anything. They have no inherent value. So these are going to be a lot cheaper, but this is also where you're going to get into the range of, is the stock actually going to get there? So this kind of brings into a pretty important point, especially when you're looking at entering your trade, and that's the concept of where does the stock actually break even? And not just break even, but when does it go into this term called in the money? In the money, it's just a fancy way to say break even, but it matters because when you look at your order entries, you're going to see, and you'll see this in Yahoo Finance, when you go into the options chain, you're going to have one set of options down here that's in the money, and one set of options up here that's out of the money. And obviously this can flip if it's a put versus a call. But for this example with OXY, right, I have a call position in this, right? So if I'm looking at the ones that are in the money, these are in the money, right? This is, $50. And then these are out of the money. This is like $60. So this doesn't have any inherent value. This has no money. The only thing that gives this option value is its time value and its expected volatility. So what you're paying for when you pay for the premium is nothing except the speculative effect that this is going to go up. And that's based entirely on its expected value, whereas these options are all based on implicit value. Now, what's really interesting is these options are obviously going to be more expensive because if you have an option that lets you buy at $40 and the price is at $50, well, that's $10 you got to pay right there, right? And so for the people that bought at $40 when it was at $40, they make 10 bucks, you're going to charge that 10 bucks obviously when you go out to sell it. But what's interesting is if you look at the actual break-even prices of these options, a lot of them you'll start to see you can actually get lower break-even points. So for me, it was at like 49 bucks right here, and you can see the break-even points for some of these options were a little bit higher because these are cheaper, right? So these are a lot cheaper, which means you put a lot less money into it to buy the option. So for these, the break-even point was sort of in this trading range right here is a little bit higher. But for these options that were already very, very, very expensive, for the ones that already had value and therefore they were more costly to enter the position and you would have to put more money down to control the underlying stock, those had a break-even range closer to the actual price. And some of them were just a couple of percentage points above the price of the actual spot price. Spot price, very, very, very simple. Spot price is just the current price, right? Very cool stuff. So when you look at the range of these options, you're going to see that the ones that cost more money, like the ones that have the most value, are going to have the lowest break-even point. So what I did in this trade is I actually saw this chain, and I saw that the break-even point was just a little bit. It was at like 49 bucks for the 47.5 option right here, which was super cool. And then the $50 option was at like 50 bucks break-even, 52, and all these were break-even at like $52. And these were break-even just a little bit less than this 47.5 one. But all of those, they were like $10, $12, $15 to get in. Whereas the 47.5 option was like, I think it was like $5 a share. So I got like 200 lots, put in a position there, and I got to control a lot more shares than if I had purchased these lower value ones. But at the same time, those would have had like a lower break even, right? So these would break even just a little bit lower, and they would have a little bit more inherent value and safety if it drops, right? Because if it drops, remember, if it drops below this price right here, this is your strike price, you're left with $0. You have no money. But if it drops, all the way down here and your option's at 40 bucks, you still have a little bit of value left. So it gives you that little bit of a safety net by paying more for the option. Now, here's what I want to recommend for you guys, because I get smoked on this position as of right now. And the reason I'm getting smoked on it is because I didn't put in the proper option trade. I got in at the wrong price. What I did was, there were options right around here that were trading for like $1 a share, $2 a share. But I saw the ones that were down here, 47.5, and I said, oh, I should buy that one because it has a lower break even. It's about a 5% lower break even price. And so I did that, and those were like they were like $5 a share, right? So quintuple the price, and yet you're only gonna change the actual value. You're only gonna change the break even by just 1 or 2%, a very small percent right here. So you're risking a whole lot more to get a whole lot less. And so that's why a vast majority of the time, pretty much every trading situation, you really want to enter your options trades at a strike price that's very, very, very close to the spot price. What that's going to do is, and obviously you would look at it and look at the break even and make sure it makes sense, but you want to sort of minimize that upfront investment so that the upside you have is multiplied, right? So you have a higher risk-reward ratio based on a lower level of risk by putting less cash into the trade. That's a very powerful concept. You want to make sure that when you get in this position, what you're doing is you're setting yourself up for success. You're not setting yourself up for failure. And the way to do that is to trade at a level where you have a reasonable break-even. Not have to go up a crazy amount for you to break even. And make sure you enter a strike price that makes sense. So your break even's close, but you're not paying too much to get into the position. And a really good way to do this, right, is to use those limit orders so that when you do enter this position, you get the best deal possible by focusing on getting yourself in at the most optimal price that the market will allow you to pay. And putting in a bid that's just a little bit lower than the market price, you get in at a little bit cheaper than the market price and absolutely knock it out of the water when it goes in the green, which is the goal with it, right? So a lot of really powerful concepts here. Still waiting for this trade to work out, so we'll see how it goes. I'm super excited about it. I love the setup based on technicals, and we'll break down how to really get into those technical-based trades in just a minute so that we can get your options leveraged so that not only are you actually able to scale based on stocks going up just a little and you making a lot, but you're able to multiply the rewards that you get from technical setups that are already proven to have high risk reward ratios and have really, really solid success based almost entirely on the actual underlying price movement of the stock, which translates into the options premium and therefore leads to your profit. So really cool stuff, guys. Hope you got a ton of value from this and now know the exact factors that you're going to have to put into your broker, you're going to have to put into your order box, you're going to have to put in when you actually go to enter the trade. The only other thing you need to worry about is how much to buy, and that really just depends on your diversification, your position size, and your correlation. And it's obviously something we talk about 9 at noon in chapter 35, and we'll get more into getting that optimal position size in another module. So thank you guys so much. We got a ton of value. Go out there, crush it, apply it, be amazing, and I will see you in the next module. Thank you. Awesome. So now we're going to talk about leverage and dealing with losers. So I think it's really important. Obviously, with a stock, if you want to just cut your losses and after it goes down, say like 33%, all you do is you set a stop loss and you say, look, if it gets to this price level, I'm out. Similarly, if you want to lock in your upside after it goes up like 60%, all you do is say, look, I want to lock in my upside. You can put in a conditional order. You can put in a market touched order. These are all orders that we cover in chapter 19 of 9 to noon. So that's all in your hands to use, but very basic level. It's just an order that triggers automatically once you get to a certain price point, and then you can sell and take your profit, or you can sell and take a loss. And that's really powerful. Limiting your losses is really the basis of overarching long-term growth in the market. And obviously, you guys know this. We talk about risk-reward ratios. Obviously, to have a defined ratio, you need to have a defined downside and have a very disciplined stop loss. Now, this is something that I don't think gets talked about enough in like financial classes or trainings, or especially with like management where you're on the line putting your trades in. And it's this idea of money and emotions, okay? Now this is probably one of the most difficult things for me to overcome when I was starting out in the markets, when I was starting out with trading, because I was like pretty connected with money, like a lot of people are. They're in this place in their life where, their whole mind is kind of wrapped around money, and that's a bad place to be, especially in the markets. If you're trying to trade for income, you're trying to create a lot of growth in your portfolio, or specifically you're trying to create sort of like financial freedom with whatever it is you're doing, or maybe replace your job with new income, you really need to separate your money from your emotions and understand that you can have bad months and good months, bad weeks and good weeks. Now the goal is to get to the point where you're very, very, very consistent, and week after week after week you're trading profitably. And that's a place that is the power state to be in. As soon as you get there, everything changes. But the most important thing to overcome, and the number one mistake people make, is that they have these emotions that are associated with money, and they can't overcome it. Look, the stock market is a very, very, very logical place. If you can't cut your losses without a blink of an eye, without the bat of an eye, and say, look, you know what? I'm out at this price level. And obviously, this price level can be a lot better defined through technical analysis. Obviously, this price level can be a lot better defined through technical analysis. But the important part with this trade is the idea that you need to dissociate emotions from your trading. It's so important to be able to just say, look, I'm cutting my loss here, that's it, this is a hard stop loss. This is the number one thing. I see people, they start investing, they start active management, they start trading 9 to noon, and they get in a position like this, and this is 9, this is noon, and they just aren't able to cut their losses, and it goes down and down and down and down and down. And it goes from losing 30% to losing 60%, because that can happen, and you need to have a target for what you're doing. So with a trade like this, you would want this to go up like 150%, like a lot, right? And when you get a lot of upside, you can risk downside like that. But the important part is to use sort of the technical setups that we're going to obviously develop, and they're in 9 to noon. I mean, they're everywhere, and we're going to get into them in this options course. And so when you use the technical setups, you have a very set risk level, and you also dissociate your emotions from that risk level, so you don't think, like, I know this is a big, big, big problem I had when I was first starting out, and it was tough because everyone was like, you have to dissociate your emotions from money. You can't react to the environment. You can't react to the economy. You can't react to these investments. And it was tough, dude. I remember you guys might have heard this story, and it's in 9 to noon. That NVIDIA, right? NVIDIA, they reported earnings, and I owned them
at the time. They were one of my first positions. They were like 25% of my portfolio. Totally overweight. I mean, it was just ridiculous how much this was, because I didn't really have solid diversification at the time. I didn't know how to really master my investments, and I was learning. And so with NVIDIA, they were going down and up and down and up and down and up, and it was a downward wedge, right? And I read this information online that said like downward wedges were bad. So I bought like right around here just by pure chance, because I was like, I like NVIDIA, they're a cool company. And I was learning about technical analysis as I started to go through, the process of investing in them and learning more about like building money with assets and investing in the stock market. And I got to this point right here where like they were reporting earnings on this day. And like logically, I knew that like, look, I should just see what happens. I should own this stock. I think it's a cool company. I think they're going to crush it. But I had this connection with money and emotions, and it was actually pretty interesting. Some of you guys might have heard this, some of you guys might not have. I was driving to school with my mom. We get to school, and I leave my phone in the car, an accident. And I'm walking into school, and then I realize, like, oh no, I left my phone. I better go grab it. So I run to the car, like, stop her on the way out of the parking lot. I grab my phone. And oh my God, everything changed because of that. So I'm like reading a whole bunch about like news and media and opinion and what people think is going to happen to NVIDIA stock. Because NVIDIA stock, in the past year, it went from like 30, 25 bucks to about $100, and that's where they were at right there. And so because of that, they had a really nice gain. So a lot of people were pretty skeptical, and a vast majority of the analysts said, oh, this stock's going to go down, this is terrible. And then I read this article that said the downward wedge was a bearish indicator instead of a bullish indicator, which it's a very nice bullish indicator, a vast majority of the time. But I didn't know that. I read wrong information online. I read lies, fraud, and it cost me a lot. But what was more important was the emotional impact, and that's what I want to stress with you here, is because this is a very difficult thing to get over, but hopefully if you hear my story and you hear sort of the process I went through, it can help you to overcome this mindset barrier faster, because it's a really big problem. So I get my phone and I'm reading all this crap that says NVIDIA's bad, and I say, well, if NVIDIA's messed up, I better get out of the position. So I call my broker at lunch and I made my decision. I said, look, I've taken a 3% profit on this trade, which was like, nothing. That's pretty good. I was in it for like a month or 2 or 3 or 4. So, I called my broker because I have my phone, and I ran back to the car to grab that phone. I called them. I said, let's get out of this position. So they got out of the position, and I get home after school. NVIDIA reports earnings at 4:20. So I'm at my computer, and I'm watching, seeing what's going on. And they freaking crush it. I mean, they just did amazing. They reported earnings, and within 2 minutes, they were up 20%. I can't even draw this on this chart. It is so high. I'm like breaking into the other chart. I mean, they just absolutely destroyed. They went up 20% instantly. And it was just insane. I was heartbroken. I was like, dude, are you serious? And that's the problem. That was the problem. I want you to hear the word I just used. I said heartbroken. Never stocks are in your brain, not your heart. Okay? Cannot let your emotions time your investments. I spent the next 2 hours on my bed bawling my eyes out because I lost a little bit of money. Money does not control you. Money does not control you. You control your money. You don't let it have an impact on you. That was the moment when I realized that I was letting money control me, because I was just getting out of I was still working at minimum wage at the time, and so I was still like in this employee mindset of I have to put in a bunch of hard work and I am controlled by money, versus this new investor mindset of you control your money and you make it work, you make it happen. And that the basis of that is your ability to dissociate emotions from your investments. You have to look very sternly and very technically at your investments. Look at it from a very analytical about the positions that you make, because that's the way you win. That's the way that you get the right setups and you make the profits. You stay in the trade, you get out of the trade one way or another, but you can't whine about it, you can't cry about it, because that's gonna mess up your decision-making ability, which is your one and only asset.
as an investor. The markets go up, the markets go down. All you have is your ability to make decisions, and your ability to make great decisions is based on your ability to get rid of these emotions so that your mind is clear, clutter-free, and able to focus on the information it has and the technicals at play so that you can make the right investments and the right decisions. After I realized this, I started trading 9 to noon, right? And I was finally able to really like set a stop loss. You have to set a hard stop loss. I remember one of my earliest trades, it was a little bit like this stock right here. It was going up and up and up. And I thought it was going to keep going up. And there was a little bit of a setup with it. It was like, it broke kind of above the VWAP, and it was doing really well. And then it came down here, and I set my stop loss, set my hard stop loss right here. And I set my stop loss right here, and I said, look, if it gets here, I'm out. It comes down, and I'm like, what's going to happen? And it hits just for a half a second. It hits my stop loss. I sell, and then it goes up and up and up and up, and it goes up like 30% after that. And just crushes it. I mean, this is awesome stuff. But I got stopped out right here. I want you guys to think about the emotional response you would have if that was you. Would you be angry? Would you be upset? Would you feel cheated? Would you feel like the market messed you up? I want you to take all those emotions, take anything you would think about in that position, write them all out. I was pissed, I thought it was unfair. I said, this stuff's crazy. And I took all these negative emotions, I put them in a box, and I just kind of freaking scratched them out and got them out of my life and threw them out of my mind. Because for you to succeed with investing, you have to purge these emotions. And you have to stick with the stop loss. Because if this stock had gone down another 50%, you bet your butt I would have been super happy I sold here. It's all hindsight bias, right? You just don't know with these investments. And especially when we get to those technical indicators and like actually establishing risk-reward ratios, this stop loss level is going to be crucial. And only after you've made, I'd say conservatively 100, 200 trades if you're a little bit less conservative. Like make a lot of trades before you transition into a place where you're doing a soft stop loss. So soft stop loss would be like if it gets here, maybe on like half your trades, you say you'll give it about a minute to figure it out and see if it bounces out like it does here, versus just going straight down. Because the vast majority of the time, they'll either go, they're going to go very, very quickly. So you usually set your stop losses as support resistance levels, like we'll talk about in 9 to noon, and obviously we'll talk about here a little bit more. But the point is, you have to get rid of these emotions so that you can have the discipline to get out here. You should also, this translate to your ability to get out up here when it goes up here and get out near the very, 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 very top. You want to get out all the way up here. You have to have the discipline to sell. You can't just let it go up and down like a wave and you're riding the wave up and you're riding the wave down. Like you have to stand up on the surfboard, get on the wave and commit to it. And then eventually you have to sell. You have to get off the wave. You have to decide that this is the end of your ride. That's when you take profits. And you also need to be able to stop out. You need to be able to get off that wave. You need to be able to find a new wave quickly because you're abandoning the one that maybe wasn't the right fit for you. Maybe the one that went just a little bit too fast and you couldn't catch it. That's okay. That's all right. That's the point with the markets. It's like an ocean, right? There are hundreds and hundreds of waves. And when you use 9 to noon and a lot of the really awesome things that we talk about in like the Screeners Masterclass, that's when you're able to find like that top 1% of stocks. You find those top 1, 2, 3, 4, 5 waves, 1, 2, 3, 4, 5 stocks, they're going to give you 80% of your returns. That's the power. That's the growth. And that's the development that all comes from your ability to dissociate money from your emotions so that your trading is based holistically on technicals and analysis and fundamentals and not on what most people are investing on, because most people are investing on emotion. Most people are basing their investments on what the market does, because if the market goes up, then everything's great and everyone's going to do amazing. If the market goes down, then the world's going to end. This is why you saw people in 2008 literally sell like their entire retirements at the rock bottom prices of the crash. They're following emotion. They're freaking out. And it sucks because I know a lot of people that were in this situation. It is a bad situation to be in where, literally the market is crashing and crashing. It used to be going up and up and up and up and then just go bam, minus 50% in a year. It was bad, but it showed that people link their investments to their emotions, and that messes them up because it drops down here, and instead of waiting for it to bounce way back up, they sell. That messes up everyone.
that screws over your portfolio. Everything we talk about in 9 to noon and the general membership area with like index investing is all based on long-term compounding growth. And that only comes when you stick with your plan and your principles. And that's what this comes down to, right? This comes down to having a trading plan. This is why we learn technical analysis. This is why you're investing in your education, is to learn that plan so that you can know exactly what to trade, where to trade it, how to trade it, and then get in, out as needed so you can absolutely crush it. Is that awesome? Get that? You feel that? Is that great? Okay, awesome. So now you understand that. You understand the importance of emotions. I mean, it's not just active trading. It's not just 9 to noon management. I mean, it really is all aspects of investing. It comes down in any time frame to your ability to disconnect emotions from your investments. You can't be bawling your eyes out over money. It's not a good place to be. It'll mess up strategies, your mindset, your value of your worth. Remember, a very, 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 very large part of 9 to noon trading and investing is your ability to tell yourself that you deserve. It's an innate and internal sense of value that only comes when you feel like you've overcome the barriers to entry, the barriers to your growth, and you feel like you've put in the work to get the result that you desire. And this is something that I can't give you. It only comes from you saying that you deserve and you shall have these outperforming returns. It's all an internal mindset belief. And what I want to do is, and what I'm doing, right, I'm showing you all the successes that students have, everyone's had. It's all amazing and all the potential that's here. But you have to convince yourself that you deserve. And that's the only time when the wealth will start to flow in abundance. It's when you believe wholeheartedly that you can dissociate your emotions from your money, have outperforming returns, and absolutely crush it in capital markets by taking advantage of the most powerful economic machine on this planet to absolutely crush it. Okay? So please, 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 I don't know what it takes. It's different for everybody. For me, it was a very, very long, extended period of market research, about half a year before I really was able to grow the pair and buy my first stock. But for you, it should be like getting through 9 to noon and getting through these courses, getting through this training. Like, this is what you need, and this is all you need. You need to just start after you get through this. And that's when you're going to learn just so much by implementing, taking action, and freaking doing it, okay? And you'll have the most tangible results, right? Like, when you're learning, you're not making any money, but when you're investing, you're making a lot of money. So that's the point with this, is to get you to that stage as fast as possible where you are crushing it, okay? Sound awesome? Sweet. So that's the basis of dissociating emotion from money. A very powerful concept. This is gonna come as you trade more, but you wanna really, really like focus on this. I was in an event just a couple of weeks ago, and at the event, one of the activities we did was, like, everybody got out a $100 bill, and we all got in like this line, and they really, really like got us on the edge of our seats, and they were like playing us out and saying that we were all gonna burn our $100 bills in like a big candle, and it was like pretty serious. Like, everyone was convinced of it. We were all about to do it. I mean, it was really, really emotional and really just an amazing experience. And in that process, you start to realize that, you know, you control your money, right? Your money doesn't control you. And what was interesting is after he revealed that, okay, you're done, all right? And he really, you know, they drag it out and through the event, and they're playing like music, and it's like chants of I control my money, right? Money doesn't control me. After that happened, and after they said, okay, everyone sit down with your money, he talked to people, and everyone was like so excited and so ready to burn their money because they wanted to prove that control. But what was interesting was I was talking to people, and I was listening to what they said about the event, and specifically what they said when they thought they were going to burn their $100. What was interesting is, you know, everyone in my row, like, we all had the same experience. We all went through the same process, but a lot of people, they had feelings in their guts or their minds or their bodies where they were like physically aching because they associated money with emotions, right? And so their body, you know, emotions, they control the body, right? This is something I talk about in the Think Grow Rich course a lot more, is this idea that your mental state controls your physiology. So their emotions were like physically harming their body and making them feel pain in areas of their body where they thought about burning money. But with me, it was all mental, right? Because I've been trading for years and years and years and years, I've learned to dissociate money from emotions and leave money only in the head and completely get rid of money in the gut, money in the stomach, money anywhere else in the body except for your mind. because that's the only place you should be considering an investment. And I get gut feelings on investments every now and then, but you got to remember that those gut feelings, they come from the subconscious, they come from the mind. And they're very, very, I mean, I made a lot of money going on my gut, for sure. And it's a great, great, great thing to follow. But for a vast majority of your trades, you really do need to dissociate money. And if you start to feel any emotions while trading, except for just like logic, I know I mean, I sound like a robot here, but like at the beginning, you need to be like that so that you don't get overly emotionally invested in a trade and then go down 30% and say, oh, I better stick in it because it's going to bounce, because these stocks don't bounce. A lot of the time, they will shit all day. And you don't want to be in that. You want to have that set stop loss, because you can seriously burn your portfolio quickly if you have 20% loss after 20% loss after 20% loss with no gains. Obviously, if you have 200% gains counteracting that, then you'll be good. And so that's kind of why I'm teaching you this technical analysis and this skill set that I hope you can go and apply and absolutely destroy it with. So that's my story. Yeah. So I met some other people that were trading stocks at that event, and they had that same experience. At least the advanced and the experienced investors, they all felt it only in their mind, whereas 99% of people in the room who just didn't have financial education and weren't investing in assets that created money for them, they always felt it in their gut. They felt the emotion of money in their gut when they thought about destroying it or they thought about burning it. And now this is a pretty extreme example, because seriously, everybody was 100% convinced that we were burning $100, and it was really, really intense. But think about this in your daily life. What would happen if that did happen to you? Where would you feel that? Because I know for most people, they associate money with their emotions. Their emotions, they influence their gut. You feel it in your body. And my goal here is to train you. And it's a tough process because it just kind of happens naturally as you start to invest. But one of the best things you could do is to consciously make an effort and say to yourself, look, I will not let money control me, and I will not associate emotions with it, because money's just paper, right? And I mean, when you're trading stocks, money it's literally like little numbers on a screen. So that was really kind of the easiest way for me to dissociate it, was to just think about it as numbers. And for a vast majority of my trades, this is again that principle of thinking about percent change over dollar change. So I'll look at every single trade I make. I want to know what percent I made versus what percent I risked. I don't want to know how much money I made, because first of all, that's going to associate money with emotions, money with happiness if I win, sadness if I lost. I don't want that. That's bad. But second of all, it's a lot more scalable. When you focus on percent change, all of a sudden you're measuring your performance, and you can also predict your future performance, right? So if you're thinking about managing a $10,000 portfolio today, you make 10%, you know that if you had $1 million portfolio, that would be $100,000 versus $1,000. So it scales up a lot easier when you think about the percent change versus the actual dollar amount. Now, obviously, it's important, right? You have to create, the income or the wealth or the growth that you desire. But you guys have seen sort of the magic that we've done with the compound asset growth. And if you can just create solid percent returns and absolutely outperform a vast majority of investors, that's really your key to success. And that's the point of all this options trading, all this technical analysis. The point is to increase your percent return dramatically in the exact same period of time as other investors, and trading the exact same assets in some scenarios, but just leveraging this other type of investment vehicle that allows you to increase your returns, right? You're leveraging your returns with options. So you're multiplying your upside, you're also increasing your downside. And that's the point, right? Is that you are leveraging the power of an option to buy something or an option to sell something, and therefore paying a much lower price than if you were to traditionally buy it. And that's why options too, I mean, you can lose everything. Think about what it would feel like if you lost everything. Because when I lost everything in GE, did not feel that, my gut didn't feel it anywhere in my body except for my mind. And I said, well, I guess that's how it works, because I knew going into that trade the risk of it. I knew going into that option, the upside, the downside. And so because of that, I probably should have sold it after the first day and just booked a 50% loss. But because of that, it was all contained in my head, and none of it was emotionalized. It didn't have any impact on any other of my investments, because I knew it was an isolated, single event, and I planned it out using logic and reasoning and planning for solid money growth, and completely ignoring the emotions behind that investment and what everyone else was saying about it. That's where you want to get. You want to get to a point where every trade you make is only up here, and nothing passes down into the rest of your body. You don't want to have emotionalized thoughts when it comes to your investments, your money management. That will seriously mess you up, and it can stop you from having the growth that we see with really, 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 really great 9 to noon stocks because of investment with emotion. So really powerful concept here. It applies a lot to active management. It applies a whole lot to long-term growth, especially with index investing. It's this idea, right? You have to care, but not that much. When you don't care that much, it gets the emotion out of the trade. It gets the emotion out of the investment. Because you know you'll still wake up tomorrow whether or not the stock goes up and down. And you know that you're going to live another 5 years whether the stock goes up or down. It's not a big deal. You care, you don't care that much. Okay? Cool concept. Awesome stuff. You guys excited to apply this? I'm freaking excited to teach it. So, hey, have an awesome time applying this. Go out there and absolutely crush it. I'm super excited that you guys are going through this content. It is awesome. So, hey, thank you so much. Leave a look at a Facebook comment below. Love to know what you're learning, favorite parts, or how you're applying this. I'd love to know if you're winning. Like, that is so cool. Best trade, first trade. First trade's the most important trade. Make that, you're going to be crushing it afterwards. So thank you guys so much. Have an awesome time, and I'll see you in the next module. Thank you. Awesome. So we've broken down some of the most important factors behind your options trading success. And what I want to talk about really quickly is about sort of like a short for options, and it's called writing options. Now it depends on your broker if they'll let you do this naked, which is really a fun way of saying you have to own the underlying stock if you're doing it for a stock. So if if I have like 100 shares of Nike, I can write a call or a put for my 100 shares, and that would be a covered call or covered put, right? So if I go over here and I look, maybe I say I have Nike, okay, and I have 100 shares. If I sell a call for maybe say the price is they're like what, $70? So if I sell a call at 75 and I tell somebody that they can buy it for me at 75 bucks, then that would be something I could sell. I could also sell a put at say 65 bucks. So somebody is allowed to sell or buy me at 65 bucks. So with a call, remember, if you're buying a call, then you're buying the ability to buy. So if you're selling a call, you're selling the ability to buy, which means you're selling somebody. So you will buy it from them. Versus a put, you're buying the ability to sell. So if you're selling a put, you're selling the ability to sell. So you're telling them you'll buy it from them. You show an example is with Nike, right? So Nike, they're what, like a $90 stock right now? So if they're at 90 bucks and you own 100 shares, what's really cool, remember with traditional calls and puts, right? A call gives you the ability to buy at strike, and a put gives you the ability to sell at strike when you buy a call or a put, right? When you buy. So when you write an option or when you sell an option, like with Nike, if you own 100 shares in Nike and you want to sell an option, so you can sell a call, right? You sell a call, and what that does is it actually brings you into the marketplace and you'll meet somebody. So somebody over here wants to buy a call and you could sell them that call. So with Nike, your call would be above the actual current price, the spot price. So for $90, maybe it would be like $95, right? And so you could sell a call, you would collect the premium that this buyer pays, and that premium, if it was like $4, you collect $4, right? And then they would pay you $4 a share to control 100 shares. That's $400 for a set period of time, and they'll have the ability to buy Nike from you at $95, no matter what Nike goes to. So if Nike goes to $150, you have to sell it to them at $95. If Nike goes to $40, the option expires worthless, right? And you get to keep the premium they paid, so maybe like $5 on a $95 stock, something like that. Less dramatically, if you're on the buying end of this and you want the price to go up, this person who's selling thinks that the price is actually just going to chill out and trend down or go sideways. And the goal here, when you own it and when you're actually writing this option, is to just take income from your investments. This is a very, very powerful way, especially if you're a long-term investor, to turn your passive assets that aren't really doing anything into passive income. So you could write a call or you could write a put. You write a put maybe at like $85. So remember, writing a put, somebody buys it from you for a premium, and they're buying the ability to sell the stock at $85. So they think it's going to go down. So if you're writing a put, you probably think it's going to go sideways or it's going to go up. When you sell a put, you're guaranteeing that you will buy this Nike stock at $85. So if Nike goes to $80, you're still going to buy it at 85. If Nike goes to $90, it will expire worthless because the strike price is below and it's a put, right? And so what this does is really, really interesting. If you look at the actual profit curve on this for you as a seller, as a writer of these options, what happens is you have a very nice limited upside, but you sort of have kind of like an unlimited downside. So you have to be kind of careful with this and make sure that you use strong predictions or strong technical analysis. For example, when you're writing a call, all right, and the stock price is at like $95, you're giving somebody the ability to buy it for you if the price goes up. So you're taking in, this is the amount paid, right? Yeah, or $90, my bad. So yeah, $90 here, and then this would be like $95, and you're taking in like $4 to actually control this option. Does that make sense? Is that cool? So this is the premium that you're getting, and this is the price that it was currently at, right? And so if the stock goes down, you actually get a little bit of a buffer zone because you sold this option. But if the stock goes up, you're capped. So your gains are capped, and your losses would just be like if you were normally holding the stock. Your losses are going to go down as long as the stock goes down. And this brings into question what's called a naked option. And I'll write it in blue because it's kind of important, naked. So some brokers will let you do this, some brokers they won't let you do this. You got to check with them, see what's up. This is why I'm constantly updating kind of my broker page where I recommend like the best brokers that I know of. With a naked option, you're allowed to sell an option without actually owning the underlying asset. So, for instance, with this Nike example, you would be able to take this income right here by selling an option, even if you don't actually own the underlying asset. What's that mean? Well, it means that if the option expires worthless, you don't actually have a loss. You just get to take in the profit from the premium that was paid at market price, versus using this premium as a way to sort of buffer an investment that you already have. It's called a covered call, right? It's this idea that you can create passive income by selling the options premium at market so that you get this little chunk of change and you have a capped upside, but you don't really think the stock's going to go up that much anyway, so it's not a huge deal. And this is a really, really, really great way to make money in a sideways market, is you just take your long positions and you sell a bunch of options on them for a set period of time where you don't actually think, based on the technical analysis, it's going to go above a certain price. I mean, it doesn't have to be this close to the spot price. You could sell up here for maybe a smaller amount of money. And I know a lot of people that do this, right? The only thing with it is it sort of traps you in that position if you're not allowed to have a naked option written out. So if you write a call or a put for your 100 shares, you're using your 100 shares as collateral in case the person wants to buy or sell from you in the chance that they execute the option. If the option expires in the money or is at any point during the period, in the time range, it's in the money, right? They make money on it, and they say they want to take their profits. And you've got to kind of pay out of your pocket a little bit. It depends on the position, right? So with a covered call, all you're really doing is selling it below market, but you're still selling it at a premium to what you originally owned it at. With a protective put, see, that's a different situation. We'll get to that in just a moment. But it's the same idea, right? If somebody's buying the ability to sell, means they're selling it to you. So if the market's at $80 and they're selling it to you at $85, you're losing out just a little bit. But at the same time, if you're like a long-term investor, it's like cool, right? Because you are buying at a discount and you think it's going to keep going up and up. So that would be sort of like the covered call. This is the example where you have just a little bit of investment income that comes in from your selling of the options premium. And if you actually own it, if it's a covered call, right, not naked, if it's covered, you own the underlying stock, you own the 100 shares of Nike, then you are going to have this downside. If the stock goes down,
then you'll lose your money, but you have this little buffer zone, so you make your profit. And if you're holding it for the long term and it goes down, it goes up, and it goes down, it goes up, it goes down, it goes up, you keep doing this over and over and over, here, wherever, based on technical analysis, right? So that you can sell your option and it expires worthless. You can sell your option, it expires worthless, and you're making pretty solid. I mean, I know a lot of people that make like 6, 7, 8, 10%. Very, very, very passively just by using this simple strategy, and they do it maybe for about 10, 15 minutes a month, and bam, all you do is the same thing over and over and over when you see the right technical setup on the right stock that you're already invested in. It's like basically using your skills in investing to create your own dividends based on what people are willing to pay to speculate on the options price of a given asset. This is very, very, very effective for those higher price stocks that are more influenced by market performance and aren't really going to be high flyers on their own, like maybe some tech stocks would be. Actually, an example, they're a little more chilled out compared to something like Nvidia, Indeed, where these are a little bit more actively traded and they're a little more volatile. And that's why if you do actually go and sell and write your options in these more volatile investments, you're obviously going to get paid more because you're incurring a greater risk to be in this market. And that's what we talked about earlier with this idea that there's a time value of an option. There's obviously also the expected volatility value of the option. So increased volatility means you deserve to be paid more for that options premium. And again, that options premium is nothing more than the actual price of the option. So same thing if we look at a protective put example. So say we own our 100 shares of Nike, okay, and we want to sell a protective put to generate a little bit of income. So we own it at 90 bucks, and here's like 85 bucks. So with this protective put, obviously we're going into the marketplace and we're saying, look, we're gonna let somebody sell it to us at $85 if they desire to. Now, obviously, if the stock price is 90 bucks, they're not going to sell it to us at $85. So with this investment, you would actually have a nice little profit at the beginning, and then as the stock price goes down, obviously if they execute it, then this profit would disappear. And then as it goes down and down and down, you're locking in profit here. But if it gets to that strike price at $85 and it goes lower and lower and lower, you are going to be obligated to buy at $85, even if the stock's 80 bucks. So you have this initial profit zone right here, and if the price goes down a lot, then you will get to pay out your butt. So you want to make sure you know what you're doing here. It's a nice way to guarantee profit. And also, if you already own the underlying company, or if you want to buy more of the underlying company, because remember, you're buying the stock. You're going to buy it from the guy if he executes it, if it actually becomes in the money. This is really just a great way to keep accumulating shares and also getting paid to do it by getting a little bit of a premium. And if the stock doesn't drop, then you just get to keep this extra cash at the beginning, which is super, super cool. Another really cool variation of this, this is not a protected put. This is the just selling, just writing a put. But a cool thing you can do if you're investing, for the long term, and you're kind of worried about temporary declines in the market, is you can actually buy a put. So this is kind of one of the last places where we're going to look at actually owning the underlying stock and then using options as a way to increase the ability for you to kind of stimulate that position and grow with that position. Writing options, this is just buying options, which is pretty powerful, but it's a different idea. So this plan, right, if you own the stock at 90 bucks and you want it to go to like 100, but you're a little worried that, if it drops to like 80, what you can do is actually pretty freaking cool is, you can just buy a put at 80 bucks. So if it drops below $80, then you're going to be able to sell it at $80 no matter what, right? So it doesn't matter. You have a limited downside, and then you have an unlimited upside, right? Because if it just goes up and up and up and up, then obviously this put is going to expire worthless, but the actual price of your assets are going to increase. And so when the price of the assets increase, you make money that way. And since these puts are usually, a couple of dollars for like $100 stock, or they're not very expensive, it's a nice way to limit that downside and increase your security in a position while also maintaining your upside in a long position so you can actually own the underlying company. This is a pretty nice strategy you can use if you're worried that earnings are going to suck. Just buy yourself a protected put and pay a couple bucks at market. And it's a great alternative to just selling half your position because you had a fear or something like that, based on volatility after an earnings report, which is pretty freaking cool. So with that said, what I want to get into a little bit more now is actually naked options, because this is where a majority of trading happens and where most of my profits are personally made. Because you got to remember, with longer term investments where you have the ability to sort of buy, and they're a little bit tougher to predict than swing trades or active trades. And because of that, you're not really leveraging options, you're just kind of using them as a tool to either minimize your risk or generate income. And I love, 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 love selling calls to generate income. That's a very, very good way to generate income from your assets. I don't know if I can stress that enough. I can do a whole little module on that. I mean, guys, like, think about this, right? If you have a stock and it's just kind of like, it's a reliable blue chip, normal company, goes up, it goes down. Maybe it's an index, right? Maybe it's the QQQ index and it's like the NASDAQ 100, goes up, it goes down. Like, you can sell a call here and it'll probably never get here in this time span, but you can still collect, a little bit of income from this. And this is just cash in your pocket. This is like something that a lot of new investors totally ignore when they could be creating just a little bit extra return from their investments by capping their upside and selling a call on their options. Now, obviously, this is on a case-by-case basis, but if you have a stock, maybe based on the technical setup or just based off historic performance, isn't performing very volatile, remember, you have options here. You can sell a call here, 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 you can sell a call here. And you can sell a call anywhere you want at any price. And obviously, these are going to be worth a little bit more than the ones that are sold all the way up here. But you're still getting free money by selling this call. And again, remember, it just limits your upside and forces you to sell if it does actually go above that price level. So you want to think about historically if it'll do that. Obviously, there are risks to this, right? Remember, we talked about text instruments, and the people that bought those calls, they made a lot of money. The people that sold those calls, they kind of missed out on a lot of money. They missed out on like 20%. So you want to do this smart, and it's more effective with indices, especially with the, like, short-term movements, because indices, they're not going to move 10% a day a vast majority of the time. So because of that, this is a really, really powerful strategy to use, like with ETFs, which we talk about at 9 to noon. It's just a big collection of stocks. It's really cool stuff. You can sell options and then just generate passive income by doing that. All right, so that's the power of selling calls to create passive income from your long positions in the market. Really, really great strategy, and I hope you take this, like, pause this video and, like, do this, okay? If you don't have any investments yet, write it down somewhere that you can sell calls to create income. Now, don't get stuck in a position because that would suck, okay? I know a lot of people, they freak out, and you freak out after a stock has a really, really big drop, and it sucks because it messes up their whole portfolio balancing based on, when you have this call, a lot of times you really can't have a naked version of it, so you have to actually hold the underlying stock. I know some people, right, and what happens is the stock goes up and up and up and up and up, and then it goes down, and you freak out and sell a call here to create a little bit of income, but now you're kind of limiting your upside. So don't sell it as a reactive mechanism. You don't want to be reactive, but rather you want to have this as part of your, like, portfolio management strategy. You want to be proactive with this, all right? So proactive means that once you start to approach this new high, once you're really, really pushing the boundaries, that's when you really want to sell this call to get the most value you can from it and maximize the extra revenue that you get from just holding this stock anyway. And that's a really, really, I mean, that is so powerful. This alone can increase your returns 10, 15% a year just by doing it month after month, selling, and selling these call options. A very, very powerful strategy. And if you want to minimize sort of the investment time that you put into your portfolio, just apply this to your overarching long-term portfolio, specifically like indices or really, really stable companies, and just find the ones that you know are probably going to go sideways or down for the next month, and then just write calls. And the worst that's going to happen is you're going to sell into an uptrend, and it'll probably come back down anyway. So you can average your costs out and just get paid cash money to have these options written. Okay? Is that awesome? Does that make sense? Is that cool? You guys got that? All right, sweet. So with that said, I'm going to erase this, and I want to talk a little bit more about the mentality behind a protective put, just because I want you guys to understand sort of why you probably sort of kind of have to like make a decision. And it's interesting because this setup, it relates a lot to some of the straddle setups we're going to look at soon, some of the butterfly setups, some of the iron condor setups. A lot of the more complex options trading setups, they all kind of come down to the same mentality. And the mentality is you're limiting your downside and you're giving yourself a ton of upside, but you're paying, you're paying a little bit of a premium for this, right? And that would be like the options premium you would pay to buy a put when you own the stock. So it'd be like a protected put, so it protects your downside, but you have upside. And this is cool. This is really, really great for obviously protecting yourself like earnings or volatile times like that. But what I want to ask you is, would you rather like guess and hope it doesn't go down and then pay a premium in case it does go down? Or what if you could just, make a decision on what you think the stock will do? And if you think it's going to go up, you just hold it. If you think it's going to go down, you're worried about it going down, you just set a stop loss. I see a lot of people, and they waste a lot of money buying these protected puts. And I think that money, for a vast majority of investors, could be better used just investing in naked options. They can have just like straight returns, and then leaving their standard investments alone, especially with like a long-term investment. If you're worried about a short-term decline, and you're gonna hold a stock for 10 years, like it doesn't really matter. So there's definitely a place and a time to apply protected puts. But in all reality, you kind of need to make a decision and try to base that decision on like technical analysis, right? You want to use technical analysis, obviously, but you really do need to say, do the indicators look like it's going to go up or is it going to go down? And then make a decision and stick to that decision. The instant you do that, it's going to skyrocket your output because all of a sudden you're able to stick with your basis, your gut. You're able to stick with your thoughts and your mind because you've put in the work, you've put in the strategy, and you understand how to analyze a stock. And that comes through technical analysis, looking at the chart, looking at the fundamentals, and saying, look, I think this stock's going to go up or down, and then put your bet on if it's going to go up or down. And if you don't have a solid bet, don't make a bet. Only take the trades that are going to win. You want to know how to make more money in the market, don't take the losing trades. I mean, it's very, 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 very simple. Stop losing money in trades that suck and only invest in trades that are really, really good, that you think are really, really good. And then you'll do really well, right? That's the point. Predictive put, I mean, you could use it as an alternative to a stop loss or a risk reward setup, but in a vast majority of situations, you'll see traders that are indecisive use protective puts, at least in the short term, when they're worried about short-term gain or short-term loss. They're not focused on that long-term gain if they're in their overarching portfolios. And this is basically never used for 9 to noon trading because stuff just happens too quickly to get options put in on top of actually buying the underlying stock. I mean, it's just very, very rare to happen. And I'll get into this a little bit more right now, right before we go into naked options, because it's an important concept. And it's kind of one of the last things I want to go into before we actually get into naked options, which are really powerful. And it's using options, naked options, covered calls, printed puts, but mostly naked options in 9 to noon trades. Now, this is a pretty interesting topic because not a lot of people use options for 9 to noon trades. And the reason is it's just really, really tough. So let me give you guys an example, okay? This stock, I don't know, it's like $7 here, and it's going to like $12, okay? And it's going up and up and up and up, and then you have like an ABCD setup, okay? Now, with a lot of options, you've got your strike price, right? And with 9 to noon stocks, because these are usually smaller stocks, smaller companies, if they have options, they're usually pretty spread out. So like more volume, more liquidity, more demand. Like with Nike, they have a lot of options prices, a lot of strike prices because there are a lot of people that are trying to buy Nike. So it makes sense for them to have a lot of options in the marketplace. But for these smaller stocks, you might have like one option here, $10,
maybe like one here at 750 and one here at 12. And so because of that, you have a really spread out price range. And if you look at like when you're actually trading 90 stocks, this is usually going, and this is what we talk about obviously with stock screeners. This is usually going to have like a pre-market gain, and then the pre-market gain is going to spike up the volatility, and that volatility is obviously going to like drastically increase the perceived value of the options because they have more inherent value from the gain, and then more importantly is their expected volatility just skyrockets, so their value really pumps up high as the increased volatility obviously increases your time value. So really important concept, and it's something that happens like your stocks. So what you'll see is like if you've got an ABCD set up here, right? A, B, C, and then D. Okay. Now your target on this, maybe it's like $12, and you're getting in at like maybe 9.20. Okay. You might have an option here at like $10 with maybe a $3 premium or I don't know. That's pretty reasonable, right? Like maybe a 180 premium, okay, and it breaks even at 12.8 or 11.8, okay, with a $1.80 premium, okay. Now with this position, your upside here is usually probably about $13, just based on standard ABCD setup. But your downside is you probably set a stop loss right about here at 758/750. Whatever this price level here is below the C, pretty conservative price level. And you would really want to get in right about here when it's making that new high, right about here, and you would ride it up. Again, double. You just take this run up, add it on top. It's about a $13 target for this, example. So the downside is it goes to 750. Now, if you get in at $9, you lose $1. You're risking $1 to make $3-4. That's pretty freaking good. That's an awesome little trade right there. Now think about it if you put in, it's like a $2 option, and the option breaks even at 12, right? And then your high size like $13. So putting in $2 instead of $9, which is pretty nice. But you got to remember, if this thing goes to $8, you're only going to lose $1 on the stock. But on the option, and especially if it's a shorter term option like a week, which is what you would trade, because obviously you're only going to hold this for the rest of the day. So if you're only going to hold it for the rest of the day, then it makes sense to trade the lowest time period option, because the lowest time period option is going to have the lowest time value and therefore the lowest price to buy, the premium, to actually have the option, right? So if this option goes from, the price goes from $9 to 8, but then instead of going up, it kind of dies down. Well, now you're going to get a little bit of a huge freaking problem, because this is going to react very much more than just a normal price would. This is going to decline in value drastically faster than the traditional price. Now, that would be a problem if the upside was a lot bigger, but think about it like this, right? Your target is $13, your break even's a little bit under 12 at 11.80. You break even, and then you have like, what, $1 up? So you're risking $2 to make $1. I mean, that's a bad trade, right? You wouldn't make that trade. You want to risk $1 to make $3. And so a lot of times with these shorter term options, you'll get into situations like that, and specifically with 9 to noon trades, where it just makes more sense to trade the stock. Because you got to remember, if you're trying to trade the option here, you're going to face a pretty crazy spread. I mean, this probably have about a 5%, 7% spread. And because of that spread, it's going to be a lot more difficult to get in and get out quickly. And you need to get in and out quickly of these trades, because it might be at this high point for about 1 minute and then just like die off for the rest of the day. You just don't know. And if you can't get out quick at this break-even point or above, you're freaking screwed. And if it goes down, you're even more screwed than if you just bought the stock. Now, what's cool with swing trading and with like more long-term investing and with covered calls and puts and writing options is that like you can kind of time it and take it a little bit slower, and you're not going to lose 70% of your option value in about 5 minutes. That's not true in 9 to noon stocks.
And the difference and the big problem is with the vast majority of brokers, you can't actually set a stop loss for your option very easily. It's a tough process because remember it's based on premium price, and premium price is constantly changing based on time value, based on inherent value, and for a vast majority of investments, you want your stop loss to be based on the price of the underlying stock. So if the underlying stock goes down and tanks, you get out. But with options, you can't really just like set a stop loss. You have to do like a conditional order, and then the conditional order at the resistance or the support that you want to sell at has to turn a traditional stock entry into an options order, and then select an options premium. But the options premium is compound. It's calculated based on the inherent value and the time value, right? So you don't really know what the heck your options premium price is going to be at any given point in the future, and especially with longer term trades, you don't really know what this price will be for the options premium, right? The premium, you don't know. And this is why you see a lot of traders, they'll struggle, and investors, they have a tough time because they're focused on changes in the premium price instead of changes in the actual underlying asset. And what I want to show you is that through technical analysis, if you can predict whether a stock is going to go like this or like this, that's what's more important than analyzing like the time value of the option or using those Greeks that we talked about that are just total crap. Like that doesn't matter. What matters is figuring out where the stock is going to go. And when you're making direct investments and direct trades, specifically in 90 Minute stocks, like these are already extremely volatile positions, and leveraging this is very risky because, like I said, these are the top 1% of stocks every single day. They get about 80% of the attention, the volume. Well, not necessarily the volume, but the growth, right? You see these stocks go up hundreds of percentage points in a day. I mean, they're getting a vast majority of active management money poured into them, which is awesome. But you don't see that same growth in the actual options. The options really do get messed up because it's very difficult to get yourself with a solid stop. It's super tough to have a stop loss for the options. And at the same time, when you're going into the investment, this just doesn't have the same risk reward that a normal setup has. And this has so much more liquidity. Liquidity is so huge for these because you're literally in this trade for maybe 15, 20 minutes. And you need to have perfect entries and perfect exits to get out of there. And with options, you have just this much larger spread with less volume, which means you have less people in the marketplace, which means you might maybe make a little extra, but it's really risky, and it's tougher to get out, it's tougher to get in, and it's very difficult to cut your losses. And on top of all of that, you gotta remember that you're gonna absolutely crush this if you do it right. And if you do it wrong, you're going to lose maybe what, 3 or 4 or 5, let's see, you're going from $9 to $8. So that's a little bit less than a little more than 10%, right? And your upside here, of course, is $3, which is a little bit more than 30%, 40% was $4, so 40%, a little bit more than that. So you've got a really nice risk reward ratio here. But if you do this with options, the problem suddenly becomes, and here, let me draw this in orange so that it kind of stands out and you can see what I'm talking about here. This trading range right here, if the stock is in this trading range, you make no money. This is the point where you break even. This is the point where you enter the trade, and this is like everything that you're paying to be in the trade versus paying this versus paying the actual $9, $2 to get in the trade versus $9 to get in the trade. But the problem arises when your upside only starts right here, and you might only have this little bit of upside, whereas when you're in the actual trade, you've got a lot more upside, even though you're putting up more capital at the beginning, okay? That makes sense, I get that. But here's the kicker, right? Your downside on a normal trade is just this little portion right here, and then you stop out. You're disciplined, you've detached emotions from your money, and you know that this is where you're getting out. But with this, like, the stock could go here, and you could stop out here, and you'd still be in the hole, a bunch of this premium, much of the time value, no profit whatsoever. And really, you're at the mercy of the small group of people that are trading options on this position actively as to whether or not you break even on it, you lose on it. Because a lot of times you're going to see huge spikes of volume and liquidity and volatility in the morning on 9 to noon stocks, especially after this big pre-market gain, which again we talk about in the screeners area. And so because of that, this stuff really, like the options premiums, they spike up a lot in the morning because of the volatility. And so it's very, very, very difficult to make good trades with them because you're looking at a trade where with a vast majority of positions, you need the stock to go up a whole bunch to break even. And then it's a lot to get into it. So you have to have a substantial amount of upside when it would just make like 10 times more sense to just buy the stock if it's already going to go up that much. Remember, options are really, really, really good for multiplying, like something like Nike. Like that's kind of a smaller movement company. They might, maybe they'll move 2 or 3 or 4 or 5% in a day, maybe 15% in a month if we're lucky. That's kind of, relatively a small movement. With these stocks, they're moving hundreds of percentage points in a day. You want to use options to multiply small returns and leverage small returns. And you kind of want to stick with 9 to noon trades that just produce consistent income, consistent wins over and over and over. Because they already do extremely, extremely, extremely well. And until you master these, it really, like, I've been doing this for a pretty freaking long time, and it's still really difficult to do options on these trades, at least with the brokers I'm using right now, just because of the way the marketplace works. It's slower to get in, it's slower to get out, and this dead zone right here really drags down your profit margin and cuts you out of a lot of the upside. And it just makes so much more sense to just trade the stocks and crush it going 9 to noon. So I hope that makes sense for you guys. I hope you understand that there's a very specific application for options, and I think the best way to use them is, about 1 month to 6, 7, 8 month swing trades to multiply those returns. You got to remember, right? You're risking everything when you do an option, and especially with very, very short-term options, you can get screwed. You can get screwed pretty bad. And like what would be awesome is if you could like buy an option before the pre-market gain, but like obviously, that doesn't happen. That's why you're trading the stock, is because it came up on the screeners, and that's why all the trainings I do on the screeners, because those are so important. But if this kind of like overlays the principle of like you want to get in before the big gain with the options, and that's why you would use them for earnings reports, which we'll talk about in just a little bit. So that was my rant on 9 to noon trades with options. It's something very few people talk about, just because not a lot of people actually trade 9 to noon. And then of those people that trade 9 to noon, not a lot of them trade options. So they're two very, very great skill sets to make a lot of money. And I would highly recommend you get really good at both of them, because remember, with 9 to noon, you're spending about the first 2 hours of the book. It's like chapter 1, right? Is the day. And you've got that extra like half hour at the end of the day to work on swing trades. And what I've been transitioning into lately really is spending that last little bit of the trading day working towards making some really, really awesome options picks and calls that go out there and produce, triple-digit returns, which is freaking awesome percent returns. And that's a really, really good way to spend your time. So you're kind of balancing between, the immediate growth and then that kind of medium-term growth. And that's been working really, really well for me, especially now with markets being pretty high as of time recording this. It works to kind of keep you out of, the overall crap of what's going on with the economy. You kind of create your own economy where you have total control over your income, your growth, your portfolio, because you kind of understand the ways that you can manipulate the game and play it the best way possible, which is kind of like the whole goal, right, is to absolutely freaking crush it. So I hope you guys kind of see what I'm saying with that, and it'll make a whole lot more sense once you actually start trading 9 to noon. You'll start to see like, whoa, holy crap, these stocks are insane, right? And that's kind of the point with that. So, that awesome? You guys like that? That great? So, with a little bit of delay, I'm glad We are finally at naked option. So this is really, really, really where you want to be. And this is the basis of all the complex setups we're going to look at soon enough. And this is just basic calls and puts. And like I said earlier, I mean, you guys know this, right? You buy a call, you buy a put. What's cool about, like if you buy a call, or you buy a put, I'll do like profit, loss, okay? With these trades, if this is like $0, the most you're gonna lose is what you pay for the options premium. So you pay the premium for whatever it is, and as soon as you pay the premium, that's all you can lose. Now, if it expires worthless, that's what you're going to lose. But that's all you can lose. So you know your downside, which is really good for planning risk-reward ratios. So you know your downside. Now, what you want to look at next is the stock that you're trading, right? You want to look at like the underlying price movement of the company so that you kind of know where the price will go, right? So if this is the stock chart and this is the option chart, this is the stock chart, and you see maybe a really, really nice support line here, and we'll get into support lines more later, and a really nice support line here, it's going up and up and up and up, and then it bounces down, 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 then it goes up and up and up and up, and you want to buy a put right here, you know that you really want to see it kind of go right over here. So this is like 20 bucks, this is like 15 bucks, you got $5 here, and maybe the option costs you like $1, okay? So you know that your profit potential here is $5, okay? So this is your reward, and this is your risk. That's pretty sick. That's what's cool about options, is you can set up these risk-reward ratios based on technical analysis of the inherent value of the option. Not the time value of the option, of the inherent value of the option. The time value of the option, I like to think of that as icing on the cake, okay? If I'm going to buy an option for, let's say this is a 1-year chart, okay? This is 1 year, and I'm going to buy a 6-month option just to keep my ass safe because I don't want it to expire and then I lose money. I don't want to lose money. So I'll buy a little bit more expensive option just in case it's kind of like a slow growth. Or if it's a slow downtrend, right? If instead of going down really quickly, it goes kind of slower and it takes a little bit longer. I'm totally cool with that. I like the money, I'll take it. But I'll definitely be a little more conservative with my time periods and give just a little extra time. And if you get really, I mean, because you just don't know what's going to happen, right? It might trend up for a bunch and then go down. So you just don't know. But with this trade, it's cool because like I know that as soon as the price gets here, I'm selling my option. I'm selling my put, right? I bought the put, I'm selling the put. And I'm gonna, I'm gonna execute the option, right? That's what it's called when you want to get out of a position. So if you buy a call, you buy a put, you want to execute the option. You would execute your ability here to sell at this price that's way higher than the current price. Or if it was a call, you would execute here to buy the lower price and then sell it at market, right? So that's what happens when you realize your profit on an option, you just execute it. And again, if you have a call, you're buying, so you would buy below the market and then you would sell it at the market. Same thing with a put, you're selling above the market, so you would just buy the shares at market. And then the difference obviously between these two numbers is what your option will be worth in inherent value, and you can just execute it with your broker, and they will send it to the options exchange, and you'll get your money, and there you go, right? You get your money. Now, what's cool is that on top of this spread value, which is the inherent value, you're also going to get the time value, and that's freaking sick because, say this trade gets done in 3 months, it's still got 3 months of time value, right? And so the next person that buys that, they're going to pay me a little premium for this. So it's a nice little bonus that I get. But that's not the point of it, right? Like, I'm not going into this trade worrying about the time value. You shouldn't worry about the time value, but understand that if you can get a trade done quicker, like with flowers, I got that trade done very, very quickly. I got a nice, just little extra bonus on the time value. I got a little bit extra money in my pocket based on that. I'm not thinking very specifically about time value. I'm more worried about the trade reaching its destination, more worried about the trade reaching its target by the time of expiration. And then obviously it being reasonably priced per the actual trading range, which is super important, right? The biggest thing to do is to just let it work out, right? So you know where your profit target is, you know that you've already set in your risk, and you just let it go, okay? The value of this, it might decrease just a little bit over time, but what you're really looking for here is the growth in inherent value, and that's going to be this big chunk here, and then just this little chunk is your time value. And the goal, obviously, is to find technical setups that allow you to create this big chunk of growth and therefore have really solid, like 4-to-1 risk-reward ratios, which is really good. And you make that trade 10 times, you're going to crush it. And that's really the point with this, is that you make a bunch of trades like this, and then they all do really well, at least some of them do really well, and then they have a lot more gross gains than your losses. So average gain is significantly higher than average loss. If you can do that, you can freaking crush it, and that's the point with it, which is super cool. And then again, that time value is going to help you out just a little bit to increase your profit just a little bit, which is super cool. So that's sort of the mentality behind naked options, which are really just options where you buy them, or you buy a put, you buy a call, and you don't own the underlying stock, so you're only trading the option. Some brokers, they require you to have like certain limitations or certain account features or certain margin requirements. Again, this is why brokers are always changing, so that's why I have 99secrets.com/brokers, and then you can see kind of like what I'm recommending right now. But it's pretty stable. Is you want to find a place where you can get options without having to actually own the underlying stock, because again, you're doing this for leverage, and you don't want to have to like buy the stock and then buy the option, because that's a lot of money and that's not really leveraged at all, and then you're kind of decreasing the amount of capital that you had to invest. So that's the power of just buying calls and puts and letting them do their thing. Now, since we have this example up here, there's one concept I want to talk about before we kind of finish up with this very basic, description of calls and puts, and it's the idea of like what to do with a loser. Okay, so say this company, they're doing their best, they're really trying, and for the first 4 months of this trade, they just keep staying up here and up here and up here. Like, what should you do? Now, the first thing to realize is that your inherent value is basically not going to change. It's going to stay kind of where it's at. And if you're sticking at a loss and maybe your break even is right here, then you're still going to be at a loss. The time value might decrease a little bit, but it's not going to be too huge until you get really close to the end, right? So if this is like halfway to the end, or 3/4 of the way, like this is kind of when you would start to decrease that time value. But again, you can't lose more than you put into the premium. And the cool thing is, if the trade goes south, you can sell it at any time, which is sick. But what I want to talk about is what I've been doing and what's been working really well for me is, when I make these trades, I very carefully use technical analysis. And I'm going to talk about this so much when we break down all the patterns and setups. But I'll use technical analysis to figure out, like, how long should this trade take? And the instant I can find out how long the trade should take, that's when I might add like a month or two for safety onto the options period, and then I'll just get in, okay? And then I'll just leave it, okay? So if I make a bunch of money really quickly, I might cover it, take my profits, be super happy. But for most of the trades, I realized that like I've already put in all the money I'm going to put in, and it's either going to crush it or it won't. And I let it go and I let it go and I let it go. And if it gets halfway here and it's still kind of doing nothing, I might be a little skeptical, but I'm going to leave it until sort of that last very small sliver where the time value starts to decrease really quickly, especially if it's out of the money and it still has like some of its value left. That's when I'm really going to start thinking about if this pattern's going to set up or if it's actually going to go up and I was wrong. And if I was wrong, you accept that you're wrong and try to get out of there and salvage it. But a lot of times, you'll see it'll just kind of take a little bit longer. So with flowers, it took longer than I thought to really reverse. It might go up a little bit, but in the end, it might go to where you thought it would go on that resistance line or that support line. So sometimes you just have to give it time and be patient. And that's so true for so much of investing. If that's like one thing I couldn't really stress, I can't really stress enough is patience, and just letting stuff work out. It's a very difficult skill to acquire, and I've gone through a lot of losses to really start to materialize my ability to just chill out with positions. Because what I used to do all the time is I would cut a position and then would freaking crush it the day after for the next 2 weeks. And like there was no reason I cut the position, right? Like it's not like it was at a big loss. It just wasn't moving fast enough for me. And so that's a paradigm I want to challenge you today. I want you to think like when you're going to exit a position. Logically, why are you exiting a position? Is it because you're bored of it? Or is it because like your money's locked up for too long and you need to put it elsewhere? Because a lot of time, if you're positioned for like less than a year specifically, and it's like a swing trade or a long-term investment, um, and you just decide to cut out for no reason, you're gonna start to see like you can get messed up pretty quickly. We talk about this a lot more in the book, and we can look at it with indicators. But like if you have Bollinger Bands, the Bollinger Bands are usually pretty wide. But when they start to tighten together is when the stock price isn't really moving that much. And when the Bollinger Bands tighten together, that's when you start to see the price really break out of the Bollinger Bands. Okay, and that's a pretty powerful concept. This idea that you have the most volatility after a period of condensed rest. And so sometimes you just kind of have to chill out and let it work. And I've had it happen so many times where I just decided to, and it's even happened with 9 to noon trades. I would literally say, look, let me just chill out for 30 seconds. Let's see what happens. Sit there, relax, breathe in, breathe out, and you just let it happen. And then lo and behold, you're up 15-25% because you just chilled out and didn't cut a stop for absolutely no reason. I'm not saying don't have a stop loss, have a stop loss, but if you don't hit your stop loss, and it's not moving fast enough, like maybe just chill out and let it do its thing. That's especially true for some of these options trades where you really do have a lot of money on the line, or at least a lot of risk, right? Because you're risking everything, and so you just kind of have to let it work out and not be too greedy when you do get those really nice profits. That's an important concept, and it's really cool because as soon as you master that, as soon as you have total and complete conviction and belief that your stocks, your positions, your investments, your trades will work out, you're going to magnetically attract them to work out in your life and create massive levels of success and influx of growth. Very powerful concept, and it all stems from your internal belief, internal growth, internal ability to absolutely crush it. So, really powerful concept here, guys. Super excited to, like, now you guys know options and you know the basics, calls, puts, cool, and important stuff, and now you can use them to really create your own stylized trading system, which is absolutely phenomenal. And I hope this is kind of cleared up. I know at the first half of chapter 21, which is all about options, tells a whole lot about this. But you know, these are kind of like tough investment vehicles. So hopefully this cleared up any questions you had and gave you some really actionable steps to take to have massive growth in your portfolios and help you understand the number one way to kind of leverage your swing trades and just multiply your upside while still limiting your downside and radically outperforming 99% of other investors. So super awesome stuff, guys. Hope you got a ton of value from this module. Go out there, apply it, and absolutely crush it. Thank you so much, and I will see you in the next module. Bye. Awesome. So you guys have finally got the fundamentals down, which is awesome. You know exactly how to get into the markets the right way, how to take your background, multiply its effect, and absolutely crush it using options, which is the coolest thing ever. Now we're going to go into the patterns that we're using all the time to make the best freaking swing trades in existence. So the first thing we're going to look at here is the long straddle. Now, it's not a normal straddle. This is actually a pretty freaking sweet setup, especially for those earnings reports or any other big news on a company that you know about beforehand. And of course, earnings reports are the easiest because if you look up any company into Google and then after their name, you put in earnings date, right? Earnings date. These two words have made me a lot of money. All you have to do is go to Google, type in, company,
and then the earnings date. And figure out when they report earnings, and then the day before they report earnings, if you think they're going to be absolutely crazy, you can use a long straddle. So the way this works, you have a stock at whatever price, you buy a put and you buy a call. So if it goes down a bunch, the put makes money and the call is worthless. Or if it goes up a bunch, the call goes up, makes a ton of money, and the put is worthless. So you basically don't know if it's going to go up or down, but you know that it's probably going to go a pretty decent amount. Say this is a $30 stock, I don't know, there's a $3 premium, so you're expecting a move, greater than 10%, hopefully 20%, you double your money, you'll be a happy guy. That's pretty cool trade. You notice that this is a pretty expanded, so this would be $3. You have an expanded base here just because you are buying two options, which sort of increases the cost just a wee bit. So you're putting up a little bit more capital since you don't actually have a direction that you think the stock's going to go. Obviously, if you're a freaking genius and you know that the stock is going to absolutely crush it, you can just buy a call and you can just buy the stock. But usually earnings reports are 50-50. And we talk about this a lot at 9 to noon, is that there's about a 50-50 chance for a vast majority of earnings reports unless you're an absolute genius. It's usually a 50-50 guess. And so when it's a 50-50 guess, if you can predict not necessarily the result, but that it will be a very, very large momentum, large volatility report, then you can use the long straddle to make a ton of money. Because like we talked about with Texas Instruments, that was a great example where they were either going to go up a lot or they were going to go down a lot. And you could buy a call and buy a put, and you would be all in maybe $2 a share and make 20 bucks a share. So you put in just a little bit more money so that you do have that put or you do have that call, just in case it goes opposite of the way you think it'll go. And either way it goes, you're still going to make a ton of money, which is super freaking sweet. And again, the only way that you actually lose money is if it's very small. So with that trade I made with GE, they didn't really move that much. They just kind of chilled out. So that would be where you would lose the premium that you pay. So remember, the most you're going to lose on this trade is the premium that you pay, and it has a pretty significant upside. So a very nice risk-reward ratio here, and that's all based on using the straddle setup where buy a call, buy a put, and you expect the price to go all over the place. This works very, very well for earnings reports, and when you're using it for earnings reports, recommend you give it maybe 5 days. So if you have the option of buying maybe like a 1 week option, that would probably work really, really well. Usually if you have earnings reports that have really big news, it might take about 2 or 3 days to really fully elaborate on itself. And so that's why I like to give it about a week. And then also, since you're giving it a week, remember our time value chart. I'll write this in black so you can kind of tell the difference. Remember, it decays the most in these last couple of days. So if you get into a trade and the trade goes south, you can get out of the trade before the time value starts to freaking tank, and you can get out while there's still a pretty significant time value. So that's another really, really good benefit of giving yourself just a little bit more time than you need, and not doing what I did and getting like a 2-day option, because it'll lose 50% of its value in 1 day, since if it's out of the money, then the only value is in the time value. And again, that time value can have its biggest decrease in the last couple of days. So use a 1 week or if possible maybe a 1 month option. It's just going to depend on how much money you want to invest in the trade. Obviously, this would be a greater investment and this would be a bigger little area if you went for longer term options. So you kind of have to weigh how much you're willing to risk here and how much you're willing to put in as an investment so that you can minimize the risk and maximize your profit. Because remember, you can still sell your premium and maybe retain like 75% if nothing happens and it expires out of the money, but you sell it before it expires because it didn't have a big movement based on the earnings report. And at the same time, you're still exposing yourself to the massive upside if there is a big movement. So that's a pretty powerful concept. And if you use that effectively, you should really, really be able to limit your risk to 25% down and hundreds of percentage points up. So this would be like 100+% up. So this can really set you up for a solid risk-reward ratio and let you absolutely crush it with the long strategy. So really, really good for when you know a stock or you think a stock's gonna just go berserk. Use a long straddle if you have no freaking clue if it's gonna go up or down.
This is obviously opposed to just buying call, buying and put if you think it's going to go up or you think it's going to go down. This is really the, dude, I don't freaking know. It'll probably do something cool strategy. And it works well for earnings reports because earnings reports, dude, I don't freaking know. It'll probably be a cool strategy. So that's a cool little thing you can do with your long straddle. Awesome stuff, guys. I will see you in the next setup. Thank you. Awesome. So you guys saw the initial setup for the long straddle, which is super, super great. Now I want to look at a little bit of a reversal on it and then talk a little more about the order entry and exit point for straddles. And so that, of course, would be the short straddle. So this is kind of the opposite, obviously, of the long straddle. And it's interesting. It kind of looks like a butterfly setup, which we'll get to soon. But what's cool with it is instead of actually buying a call and a put, you sell a call and a put kind of around the exact same price point. So this would be more if you just think a stock is kind of going to stay in the same trading range and not move very much, which is what a lot of these more complex option setups are kind of based around, which is pretty freaking cool, especially if you have maybe a stock that you don't think is going to go up or down too much, maybe like an index or an ETF or something like that, but you don't know really if it's going to be up or if it's going to be down, or maybe you think that it's going to stay the same trading range up and down, and it's just going to go sideways. So, you know, it literally just doesn't do anything at all. And obviously, the way you set this up, if you have them at the same point right here, it's going to be based around the middle. And another way you could do this is to sort of spread it out, kind of like we spread out our initial straddle, right? So remember with our original straddle setup, it was a little bit more spread out. So you would sell the call and sell the put, and then you're giving somebody the ability to buy it from you. If it actually goes down a whole bunch, you're going to be forced to buy at a higher price. And then same thing here, you're going to be forced to sell at a lower price if the stock goes up a whole bunch. And so that would be selling your call here and selling your put here versus selling them at the very, very center at the same point. And you can use sort of this same center strategy over on like your long straddle. So if you have a stock set up, remember with the long straddle spread out, but you could definitely do the same thing we're doing here and sell that straddle at the same price point, and then you're going to kind of narrow that trading range. So this is just this would be a little bit lower, right? It's just going to increase your cost depending on the options, right? So the options closer to the money are going to cost more versus buying, you know, a call here and a put here where it's out of the money, right? So this call or a call here, I mean, and a put here. So this put, since the price is below the current price, it would cost a lot less because it's out of the money. This call is out of the money, so it would cost a lot less. Versus buying them right in the middle, that's going to cost more, right? And so that's why you usually would spread it out for a long straddle. But with a short straddle, it makes sense to go right here in the middle because remember, you're getting paid to write the options. So you're going to get paid more when you sell in the money calls and in the money puts based closer towards that spot price most of the time. So just look at it on a stock by stock basis and figure out if it makes more sense to spread out your call and your put, or if you want to keep them in the same spot. Again, you would just, I mean, we just went over the straddle, so you're just buying your call and buying your put right here, and there you go. You know, that's the strat. And again, here you're selling a call and you're selling a put. So cool stuff. And that would be how you would sort of set up that indicator. And again, guys, if you need to reference any of this, it is all in chapter 21. So that should give you sort of the details, the fine grains. But the overarching application for a short straddle, again, really is if you just think it's going to go sideways and tinker off. It's a nice way to make a small profit. For most of the trades I've made using the short straddle, and then it's the same thing with selling calls. You might make about 2%, which I think is pretty good. You can make like maybe 2% a month per position on a pretty decent volatile, but not too crazy stock. With this strategy, that 2%, I mean, it's a pretty reliable 2%, and especially if you know what you're doing. you can do really well. I prefer using just like covered calls and just selling calls because you're only gonna make money if the stock goes up. You're gonna just sell it at a higher price, which I think works really well. But with this one, you sell them both, so you're kind of like doubling that income that you make from the positions that you have. If this is a covered straddle, or obviously if it's an uncovered straddle, you're just speculating here and making a ton of bank by selling options, which works really well. And you just write them out. And again, your upside is if the stock doesn't move, but your downside here is a little bit risky because this kind of has like an unlimited downside. Whereas the straddle has an unlimited upside, this one, the short straddle, has an unlimited downside, and that's a little sketch. So that's why you really do need to be careful with these because when you're selling options, you can get yourself into situations where you have a very limited upside and a massive downside, and that's why I'll usually stick with just selling those calls that are covered so that I know if I get out of this trade, I'm going to take my profits and my initial gains on the premium. And most of the time, you're not going to actually get forced to execute the option, and you'll just keep that premium, which works out really well. And this is great too. It just depends on that spread. So because you can just double the premium that you receive. So it's a stock by stock basis. But if you have a stock that really is just going sideways, and you think it's going to keep doing that over and over again, and you can be pretty liberal with where you sell these options. I mean, you can sell them pretty far outside of the trading range. If you're pretty confident in that, then this is a really good way to monetize that asset. And it works actually really well with like REITs. You guys know real estate investment trust, REIT, or any other kind of high dividend paying stock that pays like 4, 5, 6%. And usually you'll see those stocks, they just trend sideways and then they pay like 5% dividends. So if you're in one of those positions, especially for your long-term portfolio, this is a really good way to use options to generate income from those because they don't vary a lot, especially in normal market conditions. They just kind of go sideways and people expect to receive their dividends, and that's all they expect from the stock. So a really good way to increase your profit and really your income from those high dividend playing stocks like the REITs, mines, stuff like that, where they just go sideways, is to use this short straddle. And it works really well. And you can increase that 6% return to maybe 8%, 10%, 12% over the year just by using this one simple little trick that doubles your return. So awesome stuff, guys. That kind of sounded like the title of like some crazy investing magazine, because honestly, like it is. So definitely give it a shot, especially if you have some of these more stable long-term positions in your portfolio. This is a great way to use options for those longer-term investments that are very stable. One of the few circumstances where it makes sense to do so besides iron Condor, which we'll look at in just a moment. So really cool way to use short straddle, and it's also pretty simple, right? I mean, you sell a put, you sell a call, and that's it. So yeah, really cool stuff, guys. Again, more info in the chapter on it. I haven't been messing with these in a while just because I've been doing pretty active trading lately and just been crushing it at that. So I haven't had a need to get 10% returns when I'm making 10% a trade. So rushing up on this, and it's freaking cool, especially if you don't want to put the time in for active management, but you do have maybe an hour or two a month at the end of the month where you can just spend a little bit of time increasing the performance of your overall portfolio, which is sick. I mean, you guys are putting in the time to learn about the education and understand these concepts now, and it's just going to pay you dividends year after year in the future, because really all it takes is just sit down and have a dedicated focus on your assets for just a couple of hours a month, and you can seriously outperform a vast majority of professional Wall Street hedge fund managers that are just like having a blast. Those guys are living the dream, but a lot of times it's not necessarily the best way for you to have the most returns possible. So this is one strategy that is very rarely talked about, but it's a great way to increase your returns from those very stable dividend paying stocks. And if you do this over the course of 10 years, I mean, I want you guys to understand, like, think about the compounding effect that would have. You could make 4% more per year for the next however long until you want to retire, you want to have a big party, you want to have a big savings goal, whatever you want. Like think about the impact that would have. Go to like a compound interest calculator. That's why I'm talking about compounding, right? That's a pretty freaking big percent change. I mean, that's a big impact on your portfolio growth, and it's all just using this one simple leverage tool for options to actually write these and distribute them into the marketplace to provide additional value. Again, you want to make sure that you understand the fundamentals and you understand technical analysis when you do this, which is why I'm teaching it to you, and that'll help you minimize the risk and make sure that you know that this stock is doing nothing. But I mean, I'll be honest, if a stock has just gone sideways for the past freaking 4, 5, 6, 7, 8, 10 years, you're probably going to be cool if you sell like a 1-month option. Because you can always buy them back if like the world freaking ends. But even in 08, I mean, the biggest crash, the biggest recession in a long time, I mean, if you look at most of the major crashes, I mean, they happen over a course of months or years, right? So if you just keep selling 1-month options over and over and over and over, you've got a pretty small risk. And obviously, you increase the time period, you're going to increase the amount of money that you can make, but you're also going to increase your exposure risk over time, right? So what I would do is I would look, and say, well, how much money would I generate if I sold 12 1-month options versus maybe, I don't know, 48 1-week options versus 2 6-month options, and look at the particular stock, the particular market conditions, and especially the volatility at the time, and figure out if it makes more sense to sell them every single month, every single week. But it's pretty freaking easy to manage if you just sell them every month and you collect them check in the mail, then you do it over and over again, rinse and repeat, and you can pay those dividends, especially from like REITs or like high yield bond funds. These are really, really good candidates for short straddles because bond funds specifically, they try to keep them as stable as they can. And I talk more about it in chapter 22. Which is it's just really, really, really cool, especially if you're nearing like that retirement age or that savings goal. Yeah, chapter 22. A lot of freaking gold in there about bond investments and bonds versus bonds. I mean, just so much that you can leverage with this tool. So make sure that when you're reading that chapter, you apply this and you think, how can I multiply my returns by selling options? And then look at the value of those options and say, well, I guess I can multiply it by 5%. Whatever the percent is, like understand that this is basically free money to the extent that you get it right. You have to get it right. And so there is an inherent risk to this, right? And so that's why we're looking at the time frame, we're looking at the technicals, and we're looking at the price where you sell at so that you minimize that risk to be as small as possible. Sound good? That makes sense? If this is covered, the call shouldn't lose you any money. It's mostly the put that you should be worried about if you have to buy it at a bad price. But again, if you're averaging out your cost over a couple of years, not a freaking big deal. If you're a long-term investor and you have to sell at a super high price and then you're averaging it out over the next couple of years, not a big deal. So this is a really, 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 really good way to keep averaging into a position if you're going to keep buying stock or a fund over and over and over, specifically a fund since that's better for diversification and portfolio correlation like we talked about in chapter 35. This is a really solid way to just increase that income, and then if you ever have to buy in, then you just buy in because you're going to buy in anyway. So definitely a cool way to get paid to invest the way that you would have anyway, using the power of the short straddle. So awesome stuff, guys. Hope you got a ton of value from this. And again, these are a little bit, technical. You have to kind of know where to sell the calls and sell the puts and what to do, where to do it. And that's why I go into a lot more detail, just like word by word in the book. So please, if you are going to make big investments based off this, just review the text and make sure you know what you're doing before you go in it. So awesome stuff, guys. Thank you so much. I really appreciate it. And thanks so much for watching this module. So I will see you in the next one, and we'll look at the next setup. Thanks, guys. See you there. Awesome. So you guys seen straddles, seen short straddles. I mean, you guys are on a roll. You're on fire. Give yourselves a pat on the back, a comment, chat, whatever you like to do to show yourselves that you are crushing it. So we're getting to one that I know a lot of people, and they swear by this setup. It's called the Iron Condor, and I just can't for the life of me figure out why these guys love it so much. I know so many traders and they use it all the time. And what I noticed is that most of the people that are using this strategy are sort of like higher net worth individuals. And because of that, it's a little bit more difficult to get into 90 new trades when you have like I'm talking like hundreds of millions of dollars. And and so because of where they're at, like with 9 to noon trades, like basically you have like maybe 5, 10, 15, 30 million shares traded in a day on a $10 stock, which is like $300 million. And so if you want to create a $300 million position, it's kind of tough to do on a 9 to noon stock for most 9 to noon stocks. And so what this here is an iron condor, and you sell a put and you sell a call just like a straddle. And then you kind of limit your downside by buying a put and buying a call, just like a long straddle. So it's like a short straddle and a long straddle, and just kind of like mash them together. And this is, and basically, right, you make your profit right here in the middle when the stock doesn't move very much. So same thing we talked about earlier. If you don't think the stock's going to move very much, this is the strat. Now the difference between this and the straddle, the short straddle, is obviously you're buying a put, you're buying a call. So it kind of limits your downside to this price level down here. Now, I want you guys to see the risk reward ratio on this trade, and this is why I'm super skeptical of it. Like, I never use this. This is your risk, and this is your reward. That's pretty bad. That's really, really, really bad. And you can make this trade 1,000 times and make this teeny little reward 1,000 times and turn out profitable and make some pretty nice returns. But you're gonna make like what, like 2 or 3 or 4% on this trade. Like this is not a very cash enticing trade. And it depends on the stock, obviously, and it depends on the volatility. But usually, you're not going to make a whole lot on this trade. It's just this little bit of upside and this huge, huge, huge risk. I mean, it's like pretty much the opposite of the risk reward setup that you want to see on any of your investments, right? Most of your investments, you want to kind of risk like this much and then have the potential to gain this much. And that's the goal for so much of what you do. And this setup, it just kind of reverses that. And it basically like this is your risk and this is your reward. And that's kind of like initially what would turn me off and what's continued to turn me off. Now, a way you can kind of increase the amount of money you can make is if you get rid of these puts and you get rid of this call and you don't buy them, you only sell. That'll obviously increase your upside, and at that point, you're basically just doing a straddle. And that's something that some people do if they just have straight balls and they know that it's going to stay in the same price point. But again, this is really what we just talked about earlier with straddle. This is a short straddle. The only difference is for an iron condor, it's 4 trades, right? So you have the sell, the put, sell the call, then you buy the call, and you buy the put, and it limits your downside versus with the straddle, short straddle, you don't have a limited downside. And that's why when we were talking about it earlier, I was saying like basically it's kind of risky because you have an unlimited loss, and that's why you want to keep it usually in a shorter time frame with a more stable company and be more careful with the companies that you use this setup for. The iron condor is a little bit more versatile. You can use this sort of with any stock that you think is going to stay at the same price range because you do have this limited downside. But remember, you're buying calls and puts here, so it's going to decrease your overall profit margin since you're reinvesting cash into the actual trade. And these puts and calls are in the money, so it kind of actually makes you spend a little bit more money getting into the trade. So again, this is something that you can do if you think it's going to stay in the same price range, the same trading range. You can trade the iron condor. It's popular among some people. I don't really know why. It's a pretty bad setup. I've made a couple of things with it, and like you can make small profits, but I mean this is I just usually do my swing trades and 9 to noon trades and naked calls, and those work really well when combined with technical analysis. This is more of a setup for somebody who just kind of wants to sit there and do nothing and just play off a stock like we talked about yesterday, where it just kind of, or we talked about in the last video, where it goes up and down and up and down and up and down. There's no real defined pattern. But that would be sort of where you would use this, and then you can limit your downside. It's great in theory, and a lot of people, I mean, it's cool, but I just don't find myself using it very much. But it's kind of cool to know that you can do this if it fits into a very, very specific stock. So maybe you have a stock that's always been in the same trading range for a long time, and maybe you want to do like a 1 year setup with an iron condor. This would be a better way to do it than using a 1 year straddle, because you could have a limited downside for that 1 year in case stuff goes south. But since you're doing it for a whole year, you have a lot more upside. So again, it's not going to be as much upside as doing like active management. You're looking usually 5% here. But it just depends on the stock. So if you're interested in something like this, you're thinking about it, check out what the pricing is for your stock, because sometimes you can get like 20% selling some of these calls and puts. And 20% when the stock doesn't even freaking move is really, 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 really good. So definitely look into selling calls and puts and doing straddles or iron condors with those longer term positions, because I mean I've seen really, really, really good returns, and you got to remember the stock isn't even freaking moving. So that's a pretty nice way to do it. And the iron condor is a way that if you do go into it, you can actually limit your downside and just cut a little bit off the top here. So it decreases your risk, decreases your reward. But then there's also like a lot of risk. But there's a lot of risk with the straddle setup, right? You gotta remember the straddle setup has like infinite downside. So this one, it's safer, and it has a lower reward because it's safer. So definitely a thing to consider. But remember, if you're actually holding the underlying stock, it's a lot safer for both of these setups. It's a lot safer if you hold the underlying stock, because it's not a naked sell, and so you kind of have like collateral for it. And like we talked about in the last episode, last module, since you are holding it for the long term, most likely for a trade like this where it's just going sideways, that would allow you to keep buying in at lower prices or selling out at higher prices, which is the benefit of taking a trade like this, is that if it does go south, you're sort of just working it into your overarching long-term portfolio. And if it works, then you're just getting extra income from a stock that was just chilling out anyway, especially if it's paying dividends or any other kind of distribution. So really, really nice strategy. It complements the straddle, short straddle, and it's a good way to make it happen. If you think that stock is just going to sit there and do nothing, pretty expensive thing to set up. So you are doing 4 trades, and then 2 of those are buys, 1's are calls. So these are really, to generate cash, and then this is where you would spend that cash. And that's the point with it, is that you're giving yourself just a little profit margin right there. And, you make the trade 50 times and you can make a lot of money with it. It's just a lot of work for, well, it's not a lot of work. I mean, you could probably do this in like an hour a month for a couple of stocks. I just kind of like trading 9 to noon, and that's sort of what I do. And it doesn't really fit into that as well because I don't really follow companies that don't do anything, because that's kind of boring. So just a perspective on it, and it might fit your investing style, especially if you are nearing a savings or retirement goal. This is a really, really good way to stabilize your income, especially if you're moving into more bonds, bond funds, or just like general ETFs. This is a solid way to increase the return on those assets. I usually say like I'll never actively trade options on the SPY or the S&P, but you can use options to really increase those long-term returns on a month-by-month basis or year-by-year basis, using these option setups, using the iron condor to just get a little bit more out of your performance. Remember, we talked about this in the last module, this idea that if you can just get a little bit better, it's going to compound and compound and compound and compound. And what this does is it gives you the ability to get this little bit of extra cash with a lot less risk, since it's unlimited risk to just this risk. So you still got to be careful with it. You definitely want to be right so that you don't lose. But it's a nice little setup, and it works really well in long-term portfolios. So take it as it is, and balance it against your straddle, balance it against the time period that you're using for any kind of stock that you have, which just goes kind of in the same trading range and you want to profit from it. But also understand that these things can break out. So make sure that you are using those technical indicators and your skills with analysis of charts and fundamentals, so you can figure out exactly where the stock price is going to go and then implement the best option strategy for that movement. So really cool stuff, guys. Thank you so much for watching this module, and I will see you in the next one where we're going to talk about butterfly spreads. Woo! Thanks. Bye. Have fun. All right, sweet. So you've got condors, you've got your straddles, and your basic options. You are absolutely on fire. Now we're going to look at the butterfly setup. And this one's pretty interesting. This is a long butterfly. And if it looks kind of crazy, it's because it's kind of crazy. What you're doing here is you're going to buy a call at both of these points right here, and then sell 2 calls at the top right here. And that's, of course, at this strike price right in the middle. And the goal with it is, just like the last 2 we looked at, it stays in the same trading range, and you make a bunch of money because the stock doesn't move. It's a pretty ballsy play. So basically what you're doing is you're just selling both of the calls at the same price. Instead of selling like a call and a put, or instead of spreading out the call and the put, all you do is sell 2 calls at the same price, and then you buy 2 calls here to limit your downside. It's sort of like the trades that we're just looking at earlier. Same application as the trades we're looking at earlier. It's just a little bit of a tighter range and a freaking ridiculously crazy risk-reward ratio. But the cool thing is you do get a little bit of reward, a little bit more reward. So here we have $3 signs up here and 2 scientific dollar signs down here. So just a little bit more upside. If I was going to show you, this is sort of like downside. You get a little bit more upside with this. So it's a lot better than the Iron Condor in terms of the amount of money that you can make, but it's also a much tighter period of the price range. So you've got to be more accurate, and if you are more accurate, you can make more money with it, which is sick. That's the point, right? With that said, there's also the short butterfly. Very similar concept. You sell a put here, you sell a put here, and you buy 2 puts here. So it's basically just flipped. And the goal with this one is actually the opposite of the long butterfly. You want it to just go absolutely berserk. It's kind of like just like a long straddle. Basically at the same point, except instead of a put and a call, you would just buy 2 puts at this price right here, and you're selling puts here. So it just makes it so basically you've got upside and downside volatility accounted for, and you're going to have profit as long as the stock closes away from the center point. So it's basically just a more complex way to do that straddle, or the long straddle, where you're trading it on the volatility and you want to see a really, really big movement away from the center. And if you just put these orders in at the same point, it's going to give you, again, a more expensive order. You can see my scientific $3 signs here. It means it's a little bit more pricey because you are buying 4 options. Your upside only has $2 signs. So again, not necessarily the best trade for risk-reward ratio. If you look at the set, I mean, you're looking at, you know, a pretty decent amount more risk than the reward you're going for here. But if you're confident about the trade, you know, the stock's going to move a lot, you can kind of compare and contrast, but it's usually just a lot simpler to use normal options in some of the straddle sets we talked about earlier. And because butterflies, you know, they're just kind of like crazy spreads that are kind of tough to work with, because they do have a very, very tight trading range compared to the normal straddles. And so because of that, it's kind of tough to do. So I would recommend using, at least for most investments, using those basic calls, basic puts, and then the straddle for like earning stuff. And then if you want also the short straddle for your you know, longer term investments, your bond fund, stuff like that, where you want to squeeze a little bit more out of it, but you don't necessarily just want to sell a call every time it hits a resistance, or sell a put every time it hits a support. That's a pretty powerful strategy that I kind of prefer, and it's based more on technical analysis, and it's based on the idea that when it hits here you can sell a put, when it hits here you can sell a call, if it hits here you can sell a put, over and over and over again, until of course it breaks out of the range, and then you have to do something else. So that's just a little bit more based on technical analysis, and obviously using the technical analysis background that we've developed in 9 to Noon, and we're continuing to develop, and you're mastering right now. And so once we get sort of into the technical analysis part, we'll look at pretty much exactly where you would apply these options, pretty much just using puts and calls, which is where most of my trades are made. But again, very, very specialized places where you will see these four options combined together to create a spread, in this case a butterfly spread, and it works pretty freaking well. You know what you're doing, but again, you do have a pretty large risk relative to that reward, so you definitely want to be careful with it, and not necessarily something you're going to use every single day, but you can find a use for specifically in situations with a short butterfly where you think it's just going to go berserk, and you can also kind of tighten up the trading range versus a traditional go berserk setup with options. Like with the Straddle, it's a little bit wider unless you do them at the same point, but if you do them at the same point, it's really, really similar. You just have a little bit more upside on the Straddle, so probably recommend that. And then here, it's really just kind of like the same thing as the Iron Condor, except you have a lot more upside with a much more narrow trading range. So for some reason you think a stock's just not going to move, maybe it's a short time period, like just 1 month. That's a pretty solid reason to use this as a way to kind of increase the returns that you would normally get. You're looking at maybe like 5% here. Depends on the company. You can make more. I've seen these guys go higher. But just letting you leverage more returns out of those investments so that you can really grow your portfolio compound faster and then create the real savings and retirement you desire and absolutely crush it. So those are sort of our complex setups for options trades and specifically combining multi-leg setups. Now what we're going to transition over to is technical analysis and implementing options trades into technical analysis, specifically like where to put those calls and put orders in so that you can make the most profit possible using technical analysis and leveraged options that multiply your returns. It's pretty powerful stuff. We've pretty much covered everything that I want to focus on. The other thing is to make sure, remember we talked about this earlier, the time value of options. It decreases drastically in that last phase of time. So if you are using these like 4 options contract multi-leg setups, you want to make sure that when you sell them, you let them go to execution because you want them to expire out of the money and you want them to expire worthless. But when you're buying them, you probably want to try to kind of time them just a little bit. And again, when you're buying them, you want to time them a little bit and try to get the best price possible for these. Especially, I mean, you're using American options, right? So you can trade them whenever you want. And basically, you know, more on that in the book, but it's just like the normal way that people trade. And so because you can trade these whenever you want, you can kind of try to optimize your profit by selling these when they're, you know, what you think is their peak point. Based on technical analysis, maybe the stock's at its peak point. It's interesting. It's really, really interesting with the whole implied value thing. I have a couple of options on this one company called One Oak, and like one day their stock went down like 6%, and my options, which expired in 3 months at a price like $10 above the current spot price, they went up like 14%. It was the weirdest thing ever. They were calls. So a lot of times you are going to see some crazy stuff happen with these options. And so something like that happens if, you know, the price of the stock goes down, but your call options increase in value because the marketplace demands them because of increased volatility, increased speculation, or just some other reason why people really wanted those options. Totally don't be afraid to sell these before the end of the position. You can bank a really good profit and protect your downside by having that profit already locked in. It's a really, really powerful strategy and a great way to absolutely make it happen by leveraging, you know, the fact that with most of these multi-leg setups, you're not only selling, but you're also buying. And then obviously, if you're going to do this more actively, definitely make sure you can grab a broker that lets you do naked writing, make it so like you can sell these options without actually owning the underlying stock, because you probably don't want to own the underlying stock if you think it's going to go absolutely berserk, or if you think it's just going to stay in the same place. If it goes absolutely berserk, you lose a bunch of money. And if it just stays in the same place, especially if it doesn't pay a big dividend, you might just be kind of wasting your time. But if it pays like 5 or 6% dividend, maybe it's cool to own it. But for most of your active management, swing trading, especially with options, you basically, like, I never would trade. I usually, like, very rarely will I trade an option setup or just any options trade on a stock that I already own, because I don't really want to get overweight in that stock. I don't want my whole portfolio to be dependent upon the performance of that one stock, especially if it's like a 4-month option swing trade. Like, I'm either in it with options or I'm in it with just normal cash or a normal short position. And options are sick because it's way easier than shorting. To just buy a put with most brokers. And then you don't have to pay like lending fees and you don't have to pay dividends. I mean, they're really, really, really good because when you buy the put, you're not paying. If the stock has a dividend, you don't have to pay the dividend. You just own the put, and it's like 10 times easier. So we'll talk more about that when we get into the technical analysis part and we look at actually like applying this and getting these assets into our accounts as soon as possible. So really powerful setups here. Hope you guys see the power in them and you're able to use them in interesting moments in time, specifically maybe around earnings reports or with very stable stocks. I love stocks, but stocks. Or if you think stocks absolutely berserk, definitely a good way. Just make some quick money. I mean, I'm all about showing you guys the ways to do it. You've got 3 hours a day to trade. I mean, those last hour and a half, hour, I mean, it goes pretty slow. So you'll have time to figure out setups and find ways to apply this and just turn this knowledge into money. And I think that's pretty freaking cool that you can just turn this knowledge into money. So that's the goal here, guys. Let's make bank. Let's crush it. Short butterfly, long butterfly, Condor, Straddle. You have the tools for multi-leg option setups. And now we're going to transition over to technical analysis and look at really applying these stocks. I'm pretty excited about it. Yeah, there's just a couple other things we'll go through, and then we'll get it going. So thank you so much, guys. I really appreciate it, and I will see you in the next module. Woo! Thanks. Awesome. Hey guys, so you finished most of the multi-leg setups. I just want to talk to you just for a quick moment about something I see so many new people get into. They start to trade options and they see all these, different setups, and there are like hundreds more of these like ridiculous setups. And I just want to just take a minute and say, please, 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 do not like spend too much time looking all over the place for like all the setups in existence. I just saw this thing on CNBC. I don't watch news that much, but I saw this thing, and it was this guy, and he was talking about this thing called a collar setup, and basically a collar setup is you sell a call and you buy a put, and it kind of like limits your upside and it limits your downside. And it was like a pretty expensive, time consuming, and it was a lot of work. It was a lot of work, and what I'm all about is like that 80-20, right? I want to give you that 20% that's going to give you 80% of results. And there are just so many ways that people use options to kind of like replace traditional investing and just like making a trade to buy or sell. And this is a great example, like you can't decide to buy or sell, you're indecisive. Like that's a sign that you don't know what the heck is going on. And for so many people, the best way to know what's going on is to use technical analysis to figure out what to do with an investment, right? And so that's why what we're about to go into, applying technical analysis with options investing is all based around this idea that like you want to know exactly where the stock's going to go or where it's likely to go based on the setup. And to just kind of eradicate this idea of like all the nonsense that's out there, there's hundreds of these setups that are just total crap, and it's just like ways to replace buying or selling. And what the biggest thing I want to do in the next couple of modules is to get you away from trading blind. Now, trading blind is just such a big problem. And this is when you're looking at a chart with no indicators, no technical setups, no bottom of the chart things, no on the chart things, no moving. I mean, just nothing on the chart except for the price. And that is trading blind, and that seriously can mess you up. And it's where most people start, but it's really the worst place to be because you have no freaking clue what's going on. It's like walking into like a 3D movie theater, but you don't have your glasses on. It's like going skydiving without your goggles, scuba diving without your mask. I mean, these are the tools that let you see what's going on in the market. And so that's why I just think it's crazy that a lot of people don't trade with them. So we're going to go into the most critical ones. This is obviously all part 2 of 9 to noon. And that's really, really going to be the focus of this is applying options to part 2 of 9 to noon so you can make the most money possible and use the power of technical analysis to absolutely crush it. These 2 words, they've just changed my life, and I know they can do the same for you. So with that said, we're going to transition into it now. I'm really, really excited to get into like charts and drawing, and I'm going to find my blue marker. I'm going to see the next module, and we're going to start looking at support resistance. But I just wanted to cover this real quick because I remember there were so many people just talking about callers and all these setups that were just garbage. So hopefully now you understand that like you have control over what you're doing, and just keep having control by maintaining your ability to perform technical analysis by just kind of like doing it, learning it, and you're learning it right now, which is the first step. So that's super, super cool, and you're on your way to absolutely crushing it. So thank you so, so much. Really appreciate it, and I will see you in the next module. Woo! Thank you. Awesome. So the first thing I want to talk about is hammer candles and then just general candlestick setups because you have your chart in 9 to noon. It's at the end of the chapter on candlestick setups, and it's got like the top 10 candlestick setups for bull setups and bear setups, and that chart is very, 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 very valuable. That chart has made me a lot of money, and a lot of people I know have made a lot of money off of that chart. So please, please, please reference that one. But the most important candlestick setup that it's just the most important one that has the most validity and it works the best every single time is the hammer candle. I mean, it's just ridiculous how great this thing works. You've got your big tail or your little tail. Wow, that was round. But with either of these, you're looking at a big, big, big reversal. So if, say, the movement here is going up and up and up and up and up and up and up, and then you have a big hammer candle, that's usually an indicator, a reversal. Same thing if it's going down, right? If it's going down and down and down and down and down, and then you have a big hammer candle, that's usually a really, really big indicator of a reversal. So what I will do with options here, it depends kind of on the time frame. These candlestick setups, they depend a lot on time frame. So if this is like a 1 minute trade or it's a 9 to noon trade, then I'm pretty much just gonna buy the stock, and that's that's that. But if this is like a weekly setup or a monthly setup, where these are like monthly candlesticks, I'll kind of combine this with other indicators and other setups, and I'll think, okay, does this make sense that it's going to reverse right here? Is this hammer candle going to be valid? And usually, to see the biggest moves for swing trades, you really do want to see about a 1 week to 1 month setup for the hammer candle. Great example of this was trading. They went from I think they went up maybe like $20, $200. I mean, they just absolutely skyrocketed. And what was really cool is that they had a setup just like this, where there was a really, really, really big hammer candle right before their earnings report. So I saw this, and you look at the options on here. You buy a put for $20. If I put for $20, I didn't get none of this trade, unfortunately. But the stock goes down $60 the next day after their earnings are shit, and then it goes down another $80 the next day. So the next couple of days. So basically, triple, quadruple, quintuple your money by using options with hammer candles, and then combining the hammer candles sometimes with earnings reports or just any other catalyst that's really going to speed it up. So what I'll usually do is I'll buy a call if it's going down and it's reversing to go up, and then I'll buy a put when it's going down, and usually just hold that until I see it really kind of bottom out on the movement or peak out on the movement. And then once you hit that, you just take your profits, you have fun, and you get out of there. So those are really, really, really powerful, powerful, powerful setups. Because the hammer candle is such a powerful setup, you can use the setup and just combine it with options, and you're really going to be able to leverage your output, leverage your results. It all just kind of stems from 9 to noon, right? This idea that you can absolutely crush it by following the candlestick setups. Now there are a lot of new other ones in here. really, it all just comes down to referencing this really awesome table that you get, and that is maybe is just really cool. So definitely watch out for like the red, green, reds, where it's like green and then red and then green. That's usually a pretty solid bullish indicator. And then obviously the reverse of that is true. So if it's red and then green and then red, that's a pretty bearish indicator. And so you can base your trade like if these are weekly candles or if these are daily candles, they're going to have much more psychological significance, and therefore you can base a pretty solid trade on it. And then once you base a trade on it, you would just put in your order, and you could do your options to go long. That would be a call, or to go short. That would be your put, and that works really well. So I would definitely try that one out. And then really you just want to follow the chart. We got it right here on 234, and you follow these candlestick setups. It's really based off mostly this idea of really big red candles, really big green candles, or of course hammered candles, which are very, 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 very powerful tools. So use both of those and absolutely crush it with both of those by leveraging options to increase the output that you get for them. Remember that the longer the time frame of the candle, the more significant the setup. And you want to confirm this setup usually with other indicators, probably MACD, stochastics, RSI. Those are really good ways to confirm a hammer candle setup. And if all else goes to failure, just wait for like the candle after the hammer candle, and see what it does. And if it's green, then it kind of confirms it, and you just kind of get in. And you set your stop, about 3/4 up the wick, maybe half up the wick, and that's usually what I will do. And it works really, really, really well with investments. And obviously with options, you just kind of have that mental stop, and you have to get out. Unless you can't set a stop loss, then you would set a stop loss sort of right halfway through the hammer candle. So if it does make a new high or a new low, you kind of get out before it trends down or keeps trending up, and you got minimize your loss and maximize your upside. Because these hammer candles, they have really, really, really good risk-reward ratios. You have like a massive amount of growth and a very, very defined, limited amount of risk. So it works out really, really, really well. These are because these bodies basically act as your stop loss. They're just really, really good. Definitely more powerful than they're just awesome, awesome setups. So that is hammer candle setups. And other candlestick setups, the triple setups are really powerful. Also the engulfing ones, right? So if you have a big red candle and then a super huge green candle afterwards, and then that would be a really, really good sign for going up. And similarly, really big green candle, really big red candle, that would be a really good sign for going down and reversing. And it's just going to be stronger and stronger and stronger based on the time frame. I remember I was doing a trade on American. On American, it had a really, really big red candle and then a really big green candle. So I got in on the hammer candle, or just the candlestick reversal pattern, and it went up like 5-10%. But then just kind of tread down because it wasn't strong enough. So definitely consider like the weekly candles versus the monthly candles, and make sure that when you get into a position like American, you're trading it in the right time frame, and you take your profits when you need to take your profits, so you continue to trade, you continue to grow, and you have solid risk reward. You just keep winning over and over and over. It's a very powerful concept. Just want to make sure that you apply it the right way with technical analysis, and then you can use options to scale up the profits that you make from it. So super cool stuff, guys. Hope you get a ton of value from it. Start applying. It is awesome to be able to use these technical setups with options. It's a very powerful combo. So yeah, thank you so much, and I will see you in the next module. Woo! Thanks. Awesome! Great job getting through hammer candles and candlestick setups. Those are awesome ways to learn more about your charts without even putting anything on them, which is sweet. So with that said, we're going to get into our first indicator here, and that is RSI. This thing is absolutely killer, and it works wonders for identifying swing trades in collaboration with stochastics and MACD. Very, very, very great indicator. So by default, your look back period is going to be 14 whatever so if you have like months or weeks or days or whatever, it's 14 units, okay? This is really, really good for identifying like overarching like trends. So it's like going up and left, right, left. You would look sort of at the bottom and you would look at the RSI and you would say, well, what's the RSI doing? If the RSI is following it, that's really good. And maybe if there's like divergence, um, and this is going up and the RSI is going down, that could be like divergence, which is super cool. Divergence is huge with these trades. If you see divergence like this, RSI is dropping down, price is going up. A lot of times that's an indication that it should kind of come back down to those moving averages, so that the RSI can go back up. So really cool little sneak peek there at divergence. But with the 14 look back period, you're really able to identify those overarching swing trade trends and figure out sort of where that stock's been, where it likes to go, and where it is right now compared to its history. Remember, with the RSI, it's an oscillating indicator, so you've got it going from 0 to 100, and your key levels, just like other oscillating indicators, are 80 and 20. So you want to see oversold at 80, overbought at 20. Or oversold at 20, overbought at 80. My bad. Yeah, so when it gets up to 80, it's super, super high. The stock is super, super high, and it's probably going to come back down soon. Same thing at 20. It's super, super low. The stock's been very much oversold, and it'll probably bounce back up. Now, with the most look-back periods, especially if you're looking at like weekly charts, or daily charts, or monthly charts, with these swing trades, the look-back period of 14 isn't really going to help you as much. It kind of just looks flat and long most of the time, and it usually doesn't enter these extremes above 80 and 20. And so because of that, what I've been using for a very long time is something that I learned from a trader is super, super, super useful, and it's using a look-back period of 2. This is something I would have never thought to do. In Yahoo Finance, when you add RSI, the default's 14. All you have to do when you add it is change 14 to 2, or just like click it and it change the 14 to a 2. And what it does is really interesting. So instead of having like a stable indicator that goes up slowly, down slowly, and it's really boring, with the look back period of 2, it's much, much, much quicker. So you go up and down and up and down. And all of these are outside of the 80-20 range. So it gives you really, really, really good buy sell levels. And these complement other indicators very, 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 very well, much better than just a slow moving RSI with a 14 period look back. So I definitely recommend that when you're doing swing trade, you add this 2 period RSI to your charts, and it's really going to help you identify temporary top bottoms, temporary tops, so you can get in at the lowest price possible and sell at the highest price possible based on the current pricing trends of this local market for whatever the company is. So really powerful little trick right there you can use to sort of warp RSI into sort of like a boring version of stochastics into a super cool friend, 2 period RSI that goes absolutely berserk when the stock goes crazy. And that's a really nice little strategy. You look at this, it's like a 14 period versus a 2 period. It would go crazy here, down there, crazy, crazy. And it gives you a much more clear picture of when to get in and when to get out, because it's very much exaggerated, right? And so that's the point with it, is to really make it pop, really make it spark, and as soon as you can do that, you can get in. So if you see it really, really, really low and the price is really low and stochastics are low, MACD's low, stuff like that, that would be when you would buy like a call. Similarly, if it goes up and up and up and up and everything's super crazy high, that would probably be when you buy like a put. So a lot of really good strategies there. All you're doing is leveraging, these indicators, and then you use that as fuel to go and make the trades and trade the options and get in the positions that matter. So awesome stuff, guys. Super cool. If you can apply it, I hope you can absolutely crush it with the RSI. Really just try to combine it with the other indicators. But if you see this thing is super oversold, definitely consider putting a call option on it. And again, if you see it's really, really overbought, then you can consider putting a put and guessing that it'll fall and fall and fall and fall. And that's what people do all the time, just using the RSI, again, the 14 and the 2 period. Very, very, very strong setups and indicators And you want to really see them at those extreme 80-20 values that are going to show you exactly where you have the highest movement in the stock. Personally, like the RSI, specifically the 2-period RSI, it works really well in conjunction with other indicators. It's not as good like all on its own, just because a lot of the time it kind of just goes up and down over and over and over and over again because it is such a short look back period. So it really does help to have another indicator you can compare it to, like the ones we're going to talk about pretty much like immediately right now. So definitely a great way to make sure that the position you're in, kind of clarify it and qualify it, and then bring it over to that next step of actually making the trade on it because you know that the RSI looks good and should continue to look good. So cool stuff, guys. Thank you so much for watching this module. Have an amazing, amazing, amazing day. I will see you in the next one. Woo! Thanks.
Hey, this is John. I want to congratulate you on making it to the end of the course, which is awesome. Like I said, this entire course is completely gratis, and I hope that you enjoyed it and got a ton of value from it. The only thing I ask here at the end is that you please, if not already, subscribe to the channel so you can learn more. And when I post new courses, you can see all those new courses and you can get notified of them by hitting the bell, which is awesome. Then you can have even more trading skills. I got some good ones in the works, so I think you'll be excited for that. And if you really enjoyed this whole course, what's interesting is not a lot of people actually make it to the end. I've seen this happen through literally the dozens of seminars I've given. Very few people actually make it to the end of a curriculum. So you're part of a small group of people. So I'm going to ask you, as that special group of people that actually made it to the end, if you would be ever so kind as to just like or comment, or do both, please. Like and then just comment like anything for the algorithm. And maybe share this with share this with anyone that you know that trades trading options, and sharing the trading options with students and with friends has literally changed my entire portfolio and all of their portfolios similarly, and opened up entirely new career paths with trading and investing. So if you enjoyed it, por favor, just give me a little bit of love back. And if you want to really understand everything we talked about here at a deeper level and help support me a little bit, I would really also appreciate it if you would go and snag a copy of one of my books. It would be awesome. I'm available on Amazon or wherever books are sold. 9 to noon, freaking awesome. Great place to start. And it'll really help you hone in on the technicals, which are going to actually allow you to execute the options trades that you learned about in here. So I would definitely recommend that if you don't already have your own copy, which I'm sure a lot of you probably do. So with that said, you guys so much, and I will see you later. Bye. I talk a little bit about some investments I've made in this course. Past performance, obviously not indicative of future results, and similarly, there are high amounts of risk with options. You can literally lose all of your money. That's why it's very important that you understand at a deep level how to effectively trade and manage these assets. So obviously, I cannot be held accountable for anything that you do, taking action on anything you read or you see through this course. So it's very important that you make your own investment decisions and just be smart and be safe. And really the best way to do that is just by your position sizing. All right, if you only risk 2, 5, 7% of your portfolio on any given position when you're starting out and you're learning how to actually do things, it's not going to hurt that much when you take a hit. And that's really a solid way to start and a solid way to think about it. And then once you get the hang of it, you can start ramping up position sizes. There are some really grade A top professional traders up on Wall Street, and they will literally bet 60% of their portfolio on something if they are completely and wholly convicted on it. And I have done that before, and it has paid off in just massive proportions. I mean, thousands and thousands of percent. So when you know what the hell you're doing, you can start to make some really ballsy bets, but it's important that you actually know what the hell you're doing before that. So they don't have that foundation, they don't have that actual skill set of valuing and understanding how to trade effectively. And because of that, in the long term, almost without fail, there's always humongous stumbles, and those stumbles might be a couple grand for some people. For me is 5, 6 grand. Figures, not grand. Figures. Anyway,